All right, so just got it up. So once again, good morning, everyone. Good afternoon or good evening, depending on where in the world you are catching me from. Great to see all of you here today, and welcome to the webinar. If you can hear me and you can see my slides, do me a favor and type yes into the chat box and let me know where you're from as well. All right, great. From Hong Kong, from Malaysia, from Dubai, Philippines, New York City, Canada, too fast to read. Indonesia, I saw Texas, I saw Denver, I saw Yishun, I saw Mexico. Okay, thank you, everyone. I believe that some of you are here today because you want to create another source of income for yourself, investing and trading in the financial markets, whether from home or anywhere in the world. And many of you are here today because you want to learn how to grow your savings at a much higher return so that you can build your wealth a lot faster and you can achieve financial freedom, financial security in the near future. So today I'm going to share with you exactly what it takes and what you need to do to achieve consistent profits from your investments in a stress-free, low-risk way. And more importantly, in a way that's sustainable over the long run. So not just making huge profits in the short term, anyone can do that, but how do you make consistent profits over the long run? Yeah, I'm also going to show you how the exact strategies that I use to manage my portfolios, which are now I've built to over 12 million Singapore dollars, or about over 9 million US dollars. And how I managed to achieve double-digit returns despite all the bad news and all the market crashes. And how you too can also build a multi-million-dollar net worth and nest egg even on an average income if you follow the right investing principles. So there's a lot to learn today. Take lots of notes. Make sure you've got your pen and paper with you, your coffee with you. And if you have questions, post your questions on the Q&A tab, and I'll do my best to answer as many as possible during the Q&A session at the end of the webinar. So please stick all the way to the end for the Q&A session. At the same time, too, they do take advantage of our crazy discounts of our courses and our mentorship playbooks. As you guys know, this sale, this 60 to 70% discount sale happens only once a year. I know some of you have waited 11 months just for this sale during Black Friday, so take advantage of it. And I'll share more about the offers that we have at the end of the webinar. Yeah, so if you guys are ready, let's get going. Now, how many of you have put your money with unit trusts or mutual funds or hedge funds to be managed professionally because you think these guys should be doing a better job than me at managing money? So you put it with them. By the end of the day, you get much lower returns than you expected or even lost money. Have any of you experienced that before? If you have, type yes. All right. Many people. Now, if you have, you are not alone. It's a very common experience. My dad as well. You know, my father, for many, many years, he picked his own stocks and he did pretty well. Very conservative guy. He was getting like 10 to 15% return a year, which is not amazing, but it's not bad. But then a couple of years ago, he got brainwashed by his bank relationship manager. You know, the banks are very smart. They hire these very attractive, cute babes to kind of like charm you, right? So this relationship manager was very charming, bought him lunch and wined him and convinced him that we can do a better job than you. We can manage your money better than you. So convinced my father to put his money into some structured notes and some funds that the bank was selling to him. And I told him, Dad, don't do it, don't do it. But he didn't listen to me. Why? Because he's the father. He's like, what do you know, son? I'm the dad. So he put his money in these products. And needless to say, my dad lost over $500,000. And he was damn upset. He was so angry. He called his relationship manager and he told her, you know what? It would have cost me less money to keep you as a mistress. So that was the end of it. And from then on, he said, I'm going back to pick my own stocks. But this time he was smart. He started to listen to me, his son. He said, okay, son, you tell me what stocks to buy, right? So I started sharing with him. And now he's made back double what he lost from the bank, right? So it's a happy ending. But it's a very common experience that people have. Why? Because there's a myth that's been perpetuated by the Wall Street community, right? And the myth is that professional investors are smarter than you. They're more qualified, they're more experienced, so let them manage your money. But it's a myth. What's the reality? The reality is that the majority of professional fund managers cannot beat the market. They underperform the market. So you have to look at the facts, the numbers. Take a look at this table over here. It shows you the percentage of US equity funds that underperform the market or their benchmarks. Now, what does the market mean? When we say the market, we mean to say the market index. And the biggest one is the S&P 500. So all the fund managers, they try to beat the S&P 500, also known as the benchmark. Now, can they beat it? Very few can. You can see that over a one-year period, only 50% of fund managers can beat the index. But over the longer run, like over 5 years, 10 years, 15 years, 20 years, it's shocking. Over 90% of professional fund managers, they can't beat the index. They underperform the index. So what does it mean for you as an investor? That means that if you just buy the index, if you buy the S&P 500 index through an ETF, which you can do that easily, right? Check this out. If you just buy the S&P 500 index ETF, there are many around. The most famous one is the SPY. You could buy the SPY ETF or buy the VOO. It's the same thing. They are just managed by different companies, right? If you just buy the S&P 500 ETF, guess what? You would outperform over 90% of professional fund managers over time. That's shocking. And this is something that Wall Street doesn't want you to know, because if you know this, why would you ever buy their products, right? Just buy the ETF, because the ETF has such low, negligible management fees of 0.03% to 0.09%. It's negligible. Like over the last 10 years, the S&P ETF gained 221% return over the last 10 years. Now, if you annualize it, that's 12.38% a year return. So think about it. Over 90% of professional fund managers, they can't get more than 12% return a year, which is shocking, right? Now, these returns are despite all the market crashes in the last 10 years. Last 10 years, we had a crash in 2015, crash in 2019, 2020, COVID crash with a recession. Last year, 2022, another crash, banking crisis, high inflation, high interest rates. Despite all these crashes, you still get 12% return a year through the ups and downs. That's not bad. Without even picking any stock, you beat 90% of fund managers. Now, some of you may be thinking, but Adam, 12% return is not exciting. It won't change my life. Yeah, true, it's not exciting. But if you just save, check this out, guys. If you earn a $6,000 a month salary, which is an average income nowadays, and you save 10% of your salary, which means you save $600 every month, and you just put it into the S&P ETF, and you hold it through the ups and downs, and it's returning about 12% a year, guess what? If you are 40 years old today, if you're 40 today, by the time you retire in 35 years, your money would grow to $1.075 million. So you would guarantee that at least you can retire with at least $1 million, even with zero stock picking skills. Now, if you are in your mid-30s, you got more time, and you do this, you would have $1.94 million in 30 years. If you're in your 20s, some of you could be in your mid-20s, and you do this, you will guarantee you can get over $6 million by the time you retire without picking any stock, just buying the ETF and beating 90% of fund managers. Now, again, this is based on historical results. We can never predict the future for certain, right? But my opinion is that the future will be even better than the past returns because of technology and companies are growing even faster, right? Now, again, some of you will be thinking, Adam, I don't want to wait 25 years to get $1 million. It's too long. I'll be too old. I don't want to wait 30 years to get $2 million. I want to get the $1 to $2 million in 10 years or less in 5 years. Now, question, could you achieve this a lot faster? Could you reach your 1, 2, 3 million a lot faster? Yes or no? Yes, you can. But to do that, you must get more than 12% return a year. 12% return a year is what I call the idiot's way of investing. It's for idiots. It's for people who don't pick stocks. They just buy the ETF and you just get 12% with no pride. Okay. But if you learn how to pick stocks, which is what I'm going to teach you today, and you learn how to buy them when they're undervalued, you learn how to sell them when they're way overvalued, and you get much more than 12%, you get 15, 20, 25% return, then yes, you can achieve this a lot faster. And that's what I'll be talking about in the second part of this webinar. All right. Okay. So let's move on over here. Now, how about hedge funds, by the way? Have you guys heard of hedge funds? Hedge funds are for sophisticated investors. Now, in Singapore, for example, or in the US, in order to invest in a hedge fund, you must be accredited, which means you must be a high net worth individual. Because hedge funds are sophisticated. They're kind of like the elite forces of the hedge fund world or of the mutual fund world, right? And they are managed by the smartest fund managers. Can they beat the index? No, not. They can't as well. Over a 10-year period, check it out. The average hedge fund, they lose to the S&P 500 almost every single year. And these hedge funds are run by the most sophisticated professionals in the world. And even they cannot beat the S&P 500. Shocking, but this is the reality. Yeah. Now, some of you may not put your money with the professionals to manage it, but some of you may listen to these financial experts like analysts and stockbrokers or watch financial news to make your own financial decisions. How many of you do that? How many of you watch the financial news? You listen to financial experts, economists, and brokers and analysts to make financial decisions. Now, how has that worked out? Have you done well? By the way, if you listen to these experts, let me do a poll. Do you think that it will help you make better financial decisions? It will not help you to make better financial decisions, or will it result in worse financial decisions? Let's do the poll right now. What do you guys experience? Does it help you? Does it not help you? Or does it make you worse? All right, let's do the poll. There's a poll in front of you. Listening to them killed me. Okay. Okay, so I like to see the results, by the way. If I can, my team can just show me the results. It'd be great if I can just see the results. Yeah, so just do a vote. Take a minute or so to do the vote. Okay. So interesting, right? So most of you say that you make worse financial decisions listening to financial experts. You are right. Let me give you an example. Now, if you look at the last 14 years, check this out. Over the last 14 years, if you just bought the S&P 500 ETF, you would have gained 500% return through all the ups and downs, through the crash, the crash, the crash, the crash, the crash. You get 500% return. And if you annualize it, that's a 13.63% annualized return. Now, is that not bad? Yes or no? Without picking any stocks, getting a 13% return a year for the last 14 years, is that not bad? Is that quite okay? Not bad, right? But the sad thing is that the majority of retail investors, they didn't get at least 13% a year. In fact, many retail investors, they lost money in the last 10 years, or they only got 3 or 4% returns. Why? because they listen to all these financial experts on the financial media. Let me show you all the major headlines of the last 14 years. Check it out. Now, the bull market started in 2009, but on the 5th of October, on the New York Times, it says the Dow Jones will fall to 6,003 by the end of the year. Now, at that time, the Dow Jones was at 9,000 points. So they were saying that the market was going to crash 30% right here at the beginning of the bull market. If you listen to them, you would have sold all your stocks or shorted the market and missed 500% gain in the next 14 years. And then in July 2010, it says a market forecast that says take cover. You know, be careful, get out of the markets. And then on September 2011, Dow Jones could crash to 3,000 points in 2013. They are predicting a 70% crash in the stock market in 2011. Europe debt defaults are poised to rattle stocks, November 2012. 2014, the last time stocks were this expensive was a tech bubble. 2013, 87% risk of stock crash by year end. 2015, stocks and bonds will crash soon. 2016, here comes the biggest stock market crash in a generation. 2017, Jim Rogers, he said the worst crash in our lifetime is coming. 2018, why markets are still heading for a crash. 2019, are you prepared for a stock market crash? 2020, stock investors are making the biggest bet against the market in 9 years. Holy shit. If you listen to all this crap, for 14 years, you would have stayed out of the markets, sold your stocks, hid in a cave, or shorted the market, and you would have gotten killed or missed out on tremendous returns. Because every bloody year, these doomsday prophets and porn stars, every year they tell you the market's going to crash. Because their job is to scare you out of the markets. So you don't make any money. They make all the money. Now, who gets hurt in the end? Do they get hurt? No, you get hurt by listening to these so-called financial experts, right? That is why Peter Lynch, one of the few professional fund managers that I really admire. By the way, Peter Lynch, we said only less than 10% of professional fund managers beat the market. So Peter Lynch is one of that 10%. But not only that, he's the top 0.1% of fund managers in the world. Now, when he retired, he spilled the beans and he was the first to expose the lies on Wall Street. And this is what he said. He was very brave to say it. And many of his colleagues actually hated him for telling the truth. He said, the smart money isn't so smart. The smart money refers to professional investors. He said, they are not so smart. And the dumb money isn't really as dumb as it thinks. The dumb money refers to retail investors like you and me. You are not as dumb as you think. And it says the dumb money is only dumb when it listens to the smart money. So it's when you listen to the professionals, when you listen to the financial experts, that's when you do dumb shit. Okay? Does this make sense, everyone? Now, so why is it most of the time when you listen to these financial experts on the media, why is it most of the time you will end up doing worse? Because they tend to be bearish biased. Doom and gloom is the name of their game. If you take a look at the majority of articles on the financial news, they are all negative. They tell you that the world's going to end. They tell you the market's going to collapse. Now, but here's the interesting thing. 7 to 8 times, or rather 70 to 80% of the time, they tell you the market's going to go down, right? But the market itself, if you look at statistics, it does the complete opposite, doesn't it? Over the last 95 years, these are 95 years, you can see these were all the years where the stock market went up. Over here. So for example, these were all the years, 2015, 2011, 2007. These were the years where the stock market went up between 0 to 10% in that year. And these were all the years the stock market went up between 10 to 20%. These were all the years that the market went up between 20 to 30%. So can you see that, in fact, the market going up 20 to 30% in a year happens the most frequently, 23% of the time. Can you see that? Right? Now, does the market go down? Of course, the market goes down, but the market goes down not very often. In fact, over the last 95 years, the market has gone down only 22 years. And the market went up 73 years. So 76% of the time, the stock market will go up. And 23% of the time, the market will go down. So when these financial experts tell you that the market is going to crash, will they be right? Yes, they will be right 20% of the time. But 70% of the time, they will be wrong. And that's why listening to them, you will always lose money in the end, because you will only be right 20%, you'll be wrong 70% of the time. Now, why do they do that? Now, if these experts know that the market goes up 70% of the time, why do they keep telling you the market's going to crash every single year? There are two reasons. Because number one, bad news gets more attention. It gets more views. It's all about marketing. It's all about eyeballs. I experience this myself. When I make a YouTube video that is positive. By the way, I can hear some background noise. Can someone mute their mic? Someone out there? Okay. So like I said, when I make a YouTube video with a positive title, like I said, oh, the bull market is here. Guess what? I get very few views. And I get a lot of criticism. They say, Adam, you're a clown, right? But when I say, hey, the market is going to crash, there's bad news, I get 5 times more views. So think about it. If you are the media, would you rather give bad news or good news? Bad news, because bad news gets you more eyeballs and they can sell more advertisements. It's all about advertising, okay? The second reason is that research shows that humans are hardwired to think that negativity sounds smarter. People have the perception that bearish investors are more analytical and more risk-averse, while bullish investors who are more optimistic are emotional and impulsive. Bears are often projected to be smarter than the bulls. That's why I keep saying, bears always sound smart, but in the end, bulls make all the money and bears go broke. Does this make sense, everyone? And the most disgusting thing is that many of these people who tell you the market is going to crash, behind the scenes, those bastards are actually buying stocks. Like, for example, this guy called Jeremy Grantham, almost every year he tells you the market is going to crash. This year, he said the S&P 500 is going to plunge 50% and a painful recession will strike as the bubble bursts. Now, that's what he says in the public. If you take a look at his 13F filing in his fund, what is he doing? Let me make it bigger for you. Can you see this over here? He is adding shares. He's buying shares while he's telling you the market is going to collapse. So, something to think about. All right. Now, I'm not saying that he's a bad guy. I'm not saying that. I'm saying that a lot of them all do the same thing. All right. So, well, okay. Now, the same thing happened recently. At the end of last year, 2022, and the beginning of this year, if you look at all the financial media, 90% are all negative. 90% said that the market will crash this year. We're going to have a horrible recession. Check it out. November last year, the economist said a global recession is inevitable in 2023. In November last year, stock market will fall 25% with a US recession, says Deutsche Bank. And then over here, December 2022, global stocks face more hurdles in 2023. In January this year, IMF chief warns of a tough year for the world economy. Even more here, January this year, Michael Burry said, sell the stock market. January, JP Morgan, this guy, Marco, he said, I'm negative on stocks, right? It was all negative. Everyone was negative. There was only one clown, well, maybe not one, a few, right? But one clown you know who was positive. Who's that clown? Who was that clown you know that was positive at the start of the year? In fact, at the end of last year. Me, I'm the clown, right? So if you guys remember, I released this YouTube video on the 15th of January this year, and I said, the bull market has started. When I say that, it's based on the price action, it's based on the valuation of companies. Companies were so undervalued, and the market reversed into an uptrend. Now, by the time I released the video, I was already up close to $500,000. All right. Now, since I released that video, and since last year, the S&P 500 is up 17%. If you just bought the ETF, you're up 17%. But if you learn to pick the right stocks, the top 1% of companies, would you get more than 17%? Yeah. So over the last 12 months, this is my personal portfolio. I'm up 43% over the last 1 year, from November last year to November this year. Now, this is no big deal. I can tell you that many of my students got the same results as me or even higher returns than me. And I'm sure many of you who have been using my strategies, following the market, you would have gotten huge returns as well, right? Now, let's go on to the next myth. So the next myth that people have is that, hey, if the professional investors with all their experience, all their knowledge, all their supercomputers, all their resources, if they can't beat the market, what chance do I have? What chance do retail investors have? Again, that is a myth perpetuated by Wall Street. What's the truth? Here's the fact. The fact is that the retail investor like you and me, we have numerous built-in advantages that if you learn to exploit your advantages, you'll be able to outperform not only the experts, but outperform the market as well. And who's the first guy who revealed this dirty secret? Who's the first guy that exposed this? Again, Peter Lynch. After he retired, he exposed the dirty secrets of the fund management industry. He said this, I quote Peter Lynch, he said, I've said before that an amateur who devotes a small amount of time and study should outperform 95% of the paid experts who manage mutual funds, plus have fun doing it. In fact, when I read his book, when I was very young, called Beating the Street and One Up on Wall Street, that changed my perspective. I realized that we actually have a lot of advantages over the professionals, but we don't know it. We think that we are at a disadvantage, but we are actually at an advantage. And if you learn to use these advantages, you can beat 95% of the professionals and beat the market. I can tell you that because I have done it now for so many years, and so have my students. So it can be done. You can do it. Okay. So why? Let's find out why. Now, there are many, many reasons, but I'd like to highlight now 5 reasons why you can beat professional fund management returns. You can beat the fund managers. There are 5 reasons. Okay. Reason number 1 is simply because of management fees. Now, if you put your money with a mutual fund or unit trust, they can charge you up to 5% sales charge, plus an annual management fee of between 1 to 2%. Plus, if you sell your unit trust or mutual fund, they'll charge you another redemption fee of another 5%. That's insane. That's like daylight robbery, in my opinion. So in other words, if you put your money into some unit trust or mutual fund, you could be losing up to 7% even before you start, because you pay 5% sales charge and up to 2% management fee. And every year you keep paying the same management fee, whether or not it makes money, you keep paying them the fees. Now, if you compound that, you could be losing up to 19% of your money in 10 years and up to 34% of your money in 20 years. So simply by investing yourself and not paying these fees, you already have a huge advantage over the returns of these funds. Does this make sense, everyone? Does this make sense? Okay, so number 1, management fees. Number 2, the second advantage that you have over professional fund managers is that you don't have restrictions over what stocks you can buy. You see, for us, as long as we find a great company, there's the top 1% stock in the world, which I'll show you later my criteria of how to select the best stocks. For us, once we find a great stock, we can just buy it. But fund managers have many restrictions. For example, they can't buy stocks in certain markets. Certain funds, they can only buy US stocks. They can't buy European stocks. But recently, for example, I found great European companies like ASML and LVMH, and I invested in those companies, and they are giving very good returns. Same thing. Some fund managers, they can't invest in certain industries. Like they could buy technology, but they can't buy healthcare stocks because it's not within the mandate of the fund. But for you and I, we can buy any stock in any industry, technology, healthcare, financials, as long as it's a great company. So we have that freedom, right? Professional fund managers, they also cannot buy a stock if it's too small. But for us, we can buy any stock, whether big or small, as long as it's a great company. Like many fund managers, they couldn't buy Palantir because Palantir is not in the S&P 500. They couldn't buy it. But I bought Palantir. My students bought Palantir, and now we are up a pretty good return. And we're holding it because I think it's only the beginning. And many of the professionals have not bought Palantir yet because it was too small for them to buy. But we could get in very early and get very good returns at the beginning, right? Now, the third reason is very important, so pay attention. The third reason why we can beat the fund managers is because many times fund managers are forced to buy stocks when they are overvalued, when they're too expensive. Let me tell you why. You see, fund managers, they typically cannot hold more than 5% to 10% of their portfolio in cash. Now, here's the problem. When the stock market goes up and goes up and goes up, people get excited. They start to put their money into the fund manager. They buy a lot of funds. So they get a lot of cash. Now, when the fund manager gets a lot of cash, they have to deploy the cash. They have to invest the cash, because if they don't, people will get upset. Hey, we are giving you the cash. Why are you holding it? You should invest it, right? So the fund manager is forced to deploy the cash, but because the market has already gone up, they have to keep buying the stocks at higher and higher prices when they're overvalued. And this is exactly what happened to ARK ETF. ARK ETF, as the market went up and the fund went up, people bought more ARK ETF, so the money went in and they had to keep buying stocks when they were super, super expensive. Now, as retail investors, we don't have that problem. We have no obligation to deploy our cash immediately, and we have the freedom to wait to deploy the money only when stocks are cheap. So in fact, I tell my students, when the stock market is going up and stocks are expensive, don't buy. Don't buy. Be patient, hold cash. So for me and my students, we only buy when the market drops. When things get cheap, then we buy. But for the fund managers, they can't do that. Fund managers, they have to buy when things are very high, because that's when they get all the fund inflows. And here's the very sad thing. When the market drops, like last year when the market dropped, I bought a lot of stock. But many fund managers, they can't buy. You know why? Because when the stock market drops, the investors panic. They pull out of the fund. So when they pull out of the fund managers are forced to sell the stock at the bottom to redeem the cash to pay back the investors. So because of this, the fund manager is often forced to sell low and buy high, sell low and buy high. That's why they can't beat the market over the long run. Whereas we as investors, we don't have that problem because we manage our own money. So we can be patient and wait. When things drop, people panic, we buy. When things go up, people get excited. We don't buy, we sell to the excited people. Does this make sense, everyone? Okay. The fourth reason we can beat the professionals is because most fund managers are very short-term focused. And we can't blame them, because many of them, if they underperform the market in a few quarters, their investors could pull out of the fund, or they could run the risk of losing their jobs. They could get fired. So they always think of how to make money in the short term. Now, because they are short-term focused, what happens? They tend to buy stocks that are in favor. That means they buy stocks that everyone is buying. They buy stocks that are going up now. And because of that, they buy stocks that are, again, overpriced. And they tend to avoid stocks that are out of favor. Stocks that people hate. Like last year, people hated Meta. People hated Amazon. People hated Adobe. They were out of favor, but that's when they're cheap. But the fund managers won't buy them because they are afraid that they go down. So they follow the herd, and as a result, they tend to buy stocks that are more expensive. Most of the fund managers, I'm not saying all of them, but many of them are like that. But to beat the market significantly in the long run, we must be contrarian. What does contrarian mean? It means to say that to be a good investor, we must buy stocks that are out of favor. You see, to be a good investor, we have to buy a stock when it's very cheap. A stock is very cheap when people hate it. When no one wants it, that's when we buy it. So again, last year, what was hated? Meta was hated. Amazon was hated. Adobe was hated. Salesforce. All the technology stocks were hated last year. And those are the ones that we are buying because they were cheap, right? So because of that, great investors, in the short term, we may underperform the market in the short term. But in the long run, we outperform the market because we buy low and we get the biggest returns when the market reverses. Make sense? Okay. So let me give you an example over here. Last year, during the 2022 bear market, which were the worst three sectors? The worst three sectors were consumer discretionary, technology, and communication. These were the three worst sectors last year. The best sector last year was energy. That was the best one last year. What do you think most fund managers did last year? They bought energy because they chased what's doing well, because they want to look good in the short term, right? And they avoided these three sectors. Now, if you read my newsletter, let me show you my newsletter, by the way. Once you're my student, you can get my monthly newsletter. This was the January issue, right? So this was back in January, 8th of January. Now, if you go to page 25, let me just go to page 25 and show you what I wrote early this year there. I said over here, I expect technology, consumer discretionary, and communication stocks to outperform in the next 2 years, as these three sectors possess strong operating margins. And after a significant marking down in 2022, the highest quality stocks within these sectors offer bargains to value investors. Their share price should be driven higher by the earnings growth and re-expansion in 2023 and 2024. So I concentrated my portfolio on the worst three sectors last year. And because of that, this year, my students and I were able to outperform the market. Personally, year to date, my portfolio is up about close to 35% return, beating the market, because we buy what's hated, right? And we sell what is loved if it's overvalued. Now, same thing with Peter Lynch, as you can see. The reason Peter Lynch was able to beat the index was because he was unlike other fund managers. He bought what was hated, and because of that, you can see in the short term, he had big drawdowns, but over the long run, Peter Lynch, he managed to achieve 604% return versus the S&P of 223% return. So Peter Lynch beat the S&P by 3 times, and his annual return was 29% a year by going opposite of other fund managers. Okay, now let me give you the last reason. The last reason why we can beat professional fund managers, that we have an advantage, is we are not forced to sell our best stocks. For many fund managers, there's a guideline that no single stock can exceed 3 to 4% of their total portfolio. So that means if they have a stock that does very well and it grows big, they are forced to sell the stock and take the money and put into other stocks. So that is very stupid because you are cutting the flowers and watering the weeds. Now, we don't have that problem, right? So for us, if we have a good stock, we let it run, and that gives us the best returns. Now, if you take a look at my portfolio, for example, I just show you over here. Like one of my best stocks now, oops, give me a second. Let me just bring it up over here. Now, typically when I buy a stock, I would only buy about 2.5% allocation to my portfolio, 2.5% allocation, okay? Now, if, hold on, let me just move this, you can see, all right? Now, if you look at Amazon, my Amazon has grown from about 2.5% to 6.8%, right? My Meta has grown to 6.6% allocation. So if I was a normal fund manager, I would be forced to sell Meta, I'll be forced to sell Amazon because they are too big an allocation. I have to sell them and to buy other stocks that are smaller allocation. But I'm not doing that because I think that Amazon can still double and triple from here. I think Meta can still double from here. So I let it run. And that's how I'm able to beat the professionals consistently over the long run. Okay. Is this useful so far, guys? So let me summarize the 7 rules to outperform the professionals and to outperform the market. Rule number one, only invest in the top 1% of stocks in the market. Now you say, how do I know what's the top 1%? So later I'm going to show you, coming up in the second part of the webinar, I'll share with you my criteria of how I select only the top 1% of stocks in the US, the top 1% in Europe, the top 1% in Singapore, only the top 1%. And remember, we must be patient and only buy them when they are undervalued, when they're cheap, when they're hated. That's when we get in, and we get them at a very, very good price. The second rule to follow is when there's nothing to invest in, when there's nothing great to invest in, don't invest. Don't be like the fund manager and they are forced to chase stocks that gone up because they are forced to deploy their cash. Be patient and wait for opportunities to appear. Number 3, short-term volatility is your friend. Be greedy when others are fearful. Many fund managers, when they see a stock gets very volatile, they tend to sell it because they are afraid it will look bad in their fund. And they are afraid it would scare off their investors. But for me, I do the opposite. When a stock gets very volatile, it drops a lot, and it's a good company, I get excited and I buy a lot. Like, again, Meta and Amazon last year. Many fund managers sold it because they were scared it looks bad, but I bought it from these professionals. And that's why I've made so much money from Meta and Amazon and Adobe. Next one, keep holding stocks through short-term volatility. Do not be tempted to jump in and out. Have a long-term view to grow your wealth. Number 5, hold on to winning stocks. As long as the business is still growing and the business has huge potential like Amazon and Google and Microsoft, you want to keep holding it. Don't sell it just because it has gained 50%, because a great company can go up 10 times. It can go up 5 to 10 times. You must allow it to reach its potential over time. If you sell it too early just to get small profits, you will never make millions in a market. You will only get very low returns. Number 6, and this is where I also get very huge returns. Unlike many fund managers, I'm able to use options to turbocharge my returns, to get extra income for my portfolio. This is what I'll be talking about tomorrow. So tomorrow, do attend my webinar on how I use options to generate extra income and to boost my returns, as well as do attend Bang Pham Pham's options webinar as well. In fact, he's the Yoda of options. I'm the Luke Skywalker. In fact, he has taught me a lot about how to do a lot better in options myself, right? The seventh reason, or the seventh rule is, remember, ignore the macroeconomic news and ignore the predictions of experts. If you can do these 7 things, I can tell you, you will outperform 95% of professionals and you will beat the market and you'll grow your wealth a lot faster. All right, so let's go to the second part of this webinar right now, which I'm going to teach you how do we find the top 1% of stocks in the market. You guys ready? You guys excited to learn that? Okay. So a lot of people ask me, Adam, how do you beat the index and achieve between 20% to 40% returns a year safely with low risk and low stress? So the way to do it again is by only picking the top 1% of the best businesses in the world. Now remember, when you buy a stock, you are not buying a lottery ticket. When you buy a stock, you are buying part of a business. You're becoming the part owner, the shareholder of a business. If the business does well, the business makes more and more money every year, you will do very, very well, regardless of the macroeconomic situation, regardless of the war, the interest rate, the inflation. All that is noise. Yes, all that affects the market in the short term, but in the long run, it is meaningless. In the long run, the most important thing is to focus on, is the business doing well? Is McDonald's selling more burgers? Is Apple selling more iPhones? Is Visa having more transactions? That's the only thing that's important. Okay, so we only want to pick those great companies where everyone in the world uses their products, like you and me. And we only want to buy them when they're selling at significant discounts. So why is it so important to only buy high quality companies? Now look at this chart, for example. Again, if you just buy the S&P 500 ETF without using any brain, you can see over the last 5 years, you bought the S&P or the Dow Jones, you would beat 90% of fund managers, but the returns are relatively about 12%, 13% a year. But if you buy the high quality companies like Mercado Libre, like ASML, like ServiceNow, like AutoZone, like Microsoft, these are companies in my portfolio. These are the top 1% of companies. Look at their performance. Their performance is way above the index. And you can get 3 to 4 times more returns than just buying the index ETF. You see, when you buy the index ETF, it's like buying a music album. In the old days, we bought a music album, and not all the songs were nice. We had nice songs, we had lousy songs, right? But if you know how to pick the hit singles, and you only buy the hit single songs, will you perform better than the whole album? Yes, all right? So again, take a look at my portfolio over here. I've got 2 portfolios that I manage in the US markets, and the third one, which is for my dividend stocks in Singapore. So this one is my US one. Okay, so you can see I'm holding Amazon, I'm holding Meta, Google, Microsoft, ServiceNow, Palantir, Booking, MasterCard, ASML. These are some of the stocks I'm holding right now. And right now, this account is about 3.3 million US dollars. This second account, which I'm managing, it's about 3.4 million US dollars. Okay, so in total, it's about 6.7 million US dollars. All right, so if you convert it to Singapore dollars, it's about it's about 9 point something million, right? I've got another portfolio where it's my dividend portfolio. I hold the Singapore banks and REITs. That's about 3.5 million Singapore dollars. So if you add it all together, I currently have over 12 million Singapore dollars worth of stocks in the market, which is about over 9 million US dollars. Now, I'm not saying this to impress you. I'm not saying this to show off to you, but to tell you that I have a lot of skin in the game. All right. So whatever I'm teaching you about how to invest, these are the exact strategies that I'm using every day to manage my own money. And when the market goes up, goes down, and it's volatile, yep, I've got skin in the game. Okay, so that's the point. All right. Now, year to date, just to share with you, this is year to date, January to now. Let me just open up my portfolio to show you. Let me just open it up. Just logging into my account right now. Okay, there we are. So year to date, you can see my portfolio is up 34% so far year to date. And it's outperforming the S&P 500, which I think the S&P is up, if I'm not wrong, up 17%. So outperforming the S&P 500. But we've got one more month to go. And I think the last month of the year would still be bullish. So I'm hoping to get over 40% return this year. Again, there's no guarantee, but I think there's a good chance I may end the year up 40% return this year. Okay. Now, for the last 12 months, from November last year to November now, you can see my two portfolios I just showed you. I'm up 49% on this portfolio and up 43% on this portfolio. My total returns this year is 1.7 million US dollars. Right? So just to show you that despite the high inflation, high interest rates, we got two wars, we got all the bad news, but you can still build your portfolio consistently if you follow these investing rules and you cut out all the bullshit, you ignore the financial experts, and you focus on great companies. Yeah. So I'm going to show you what is my method. What's a strategy that I've been using now for so many years. So my approach is known as value momentum investing. And there are 4 keys that I follow religiously. I call it the 4 keys to successful investing. So please write this down. So I use this acronym WWHW. So what does it stand for? The first W stands for, the first key to successful investing is you must know exactly what to buy. You must know exactly what stocks to buy. Now, again, in the US market, there are over 6,000 stocks. You want to buy all the 6,000 stocks? No, you only want to buy the best stocks. Now, again, remember, when you buy a stock, you're buying a business. So we only want to buy great businesses. Let me say, how do I know it's a great business? So again, in a while, I'll show you my 7-step criteria of how I select great companies. And again, guys, what percentage of stocks meet my criteria? What percentage of stocks in the market are safe enough to invest in? What percentage? That's right, only 1%. Remember, only 1% of stocks are investable. 99% of stocks are not investable. Only stick to the 1%. Okay? Great. Now, the second key is once you know what stocks to buy, then you must know exactly when to buy. Why? Because remember, a great business can be a bad investment if you pay too high a price for the shares, if you buy it at the wrong time. For example, is Apple a great business? Is Apple a great company? Yes, but right now Apple is overpriced. If you buy Apple now, I don't think it's a good investment because you're overpaying for the shares. It's like buying an apartment. You could find a fantastic apartment, great view, but if it's valued at $1 million and you pay 1.3 million, you're buying it over valuation, then later when you sell it, you may not get very good returns. Understand? So a great business is only a great investment if we can buy it at less than what the business is worth, when we buy it at below valuation. So in other words, we only want to buy a great company when it is undervalued. Now you may say, how do I know it's undervalued? How do I know it's cheap? Do I just look at the PE ratio? No, the PE ratio is very misleading. So later I'm going to show you again how I calculate the intrinsic value of a business to know what is the actual value. So I know if it's cheap or expensive. Same thing. Have you heard of LVMH, Louis Vuitton? Great company, but for a long time it was too expensive. It was overpriced. But then earlier this year, not early this year, about 3 months ago, the price dropped and became undervalued for a few days. So I started buying it. I was patiently waiting for it, and I bought LVMH a few months ago. Same thing with Apple. Apple, the intrinsic value is about $150. And I think, if I'm not wrong, Apple is now selling at about 180 or 170. It's overpriced right now. But last year, Apple managed to drop to 125 briefly. That's when I started buying it when it was cheap, right? So you got to be patient. Buy it when it's undervalued, okay? And buy at technical support levels, which I'll talk about more later on. Now, the third key is to know how many shares to buy. How many shares to buy? Now, this is very important. Listen very carefully. No matter how great a stock is, no matter how great you think a company is, don't put all your money into one stock. Never go all in. That's insane. Never put all your eggs in one basket. You know why? Because no matter how great a business is, shit can happen that you can't always foresee. Like, for example, is Boeing a great business? Yes. Boeing and Airbus, they monopolize the commercial aircraft manufacturing market. And for many, many years, Boeing, the profits went up, the sales went up, it was unstoppable. And I owned Boeing years ago. But what happened in 2020? They had 2 plane crashes because of a design flaw, and the 787 MAX was grounded. They couldn't produce that model, which was the bestseller. And then we had a global pandemic. Airlines were grounded. They postponed their orders. And for the first time, Boeing lost money. And the share price dropped 80%. So can you imagine if you put all your money into Boeing and your entire portfolio dropped 80%, you would cry, right? Now, did I own Boeing before the pandemic? Yes, I owned Boeing. And my Boeing stock dropped 80%. But despite that, by the end of 2020, I still got 40% gain in my portfolio. Why? Because I diversified. So even though Boeing went down 80%, but my other stocks went up to offset the temporary decline in Boeing. Now, later on, Boeing recovered, which I then sold for profit, right? So in the end, I did get out for profit. I don't own Boeing anymore. So the whole point is this, guys. Never put all your money into one stock. Always diversify your capital into minimum at least 8 to 10 great companies. Because if shit happens to 1 or 2 or 3 of them in the short term, it doesn't matter. The rest of them would offset for the temporary decline, giving them the chance to rebound later on. Does this make sense, guys? All right. So we call this portfolio allocation and portfolio diversification, which I'll talk a bit more later. And of course, when you take the value momentum investment course that is on a great offer today, I go into detail on how to construct a bulletproof portfolio that will grow under all economic conditions. So whether high inflation, low inflation, high interest rates, low interest rates, recession, no recession, we don't care. Our portfolio will grow consistently if we allocate and diversify the right way. Yeah. The last key is you must know exactly when to sell. Now, the trouble with some people is that they sell a stock too early. When they see 20, 30, 40% return, wow, they get out. But after they get out, the stock goes up another 2x, 3x, 5x, and they miss out on huge returns. Then some people, they sell too late. They buy a great company, it goes up a lot, it gets way overvalued, but they don't know when to get out, and they lose 80% of the profits. Has that happened to you before? So you cannot sell too early, but neither can you sell too late. You got to have the rules of exactly when to sell. So later I'll talk more about it. And again, in the course itself, I go into detail where we only sell a stock if it stops growing, if it loses its competitive advantage, if it's no longer a great company, we get out. Or we can also get out if it's still a great company, but it's way overpriced. Nothing wrong with selling the stock when it's way overpriced, take the money and buy it back again when it gets cheap again, or buy something else just as good that's cheap. For example, early this year, I sold McDonald's and I sold Yum Brands because they were way overpriced. And I took the money, I waited, and now I just bought back McDonald's again at a lower price. So these are things that you can do, right? Is this useful so far, guys? So why do people lose money in stocks? If you have lost money in stocks, there are only 4 reasons. The first reason is because you did not know what stock to buy. And you bought lousy companies that were losing money. If you do that, of course you will lose money, right? The second reason people lose money could be that they bought great companies, but they bought it at the wrong time. They bought it when it was way overpriced. They overpaid for the share. So it took a long time to break even. And then when it was overpriced, it dropped, they panicked and they sold and they lost money. Okay. The third reason could be that they over-allocated. They go all in onto Alibaba, or all into Boeing, or all into PayPal. And then when shit happens and that drops, their whole portfolio drops. Now, many of you know that I own Alibaba as well. I own Alibaba, I own Tencent, and yes, those 2 stocks have been the problem child. I also own Disney, right? And these stocks have dropped 50, 60%, correct? But I don't care. I don't care. Even if it goes to 0, I don't care. Alibaba can go to 0. I don't care. I will still get 30, 40% a year return. Why? Because I diversify so that the gains of my winning stocks far outweigh the temporary drops from my losing stocks. Okay, so when you diversify properly, even if shit happens to certain stocks, you don't care. Okay, it's all about diversification. And the last reason, again, people lose money is they don't know when to sell. They don't know when to take profits. Now, let me go into greater detail right now into the first step, which is knowing what to buy. Again, we are only interested in buying the top 1% of stocks in the market. So like I mentioned, I've got a 7-step criteria. Before I buy a stock, it must meet my 7-step criteria. What's my first criteria? My first criteria is this. I only invest in businesses that have a history of consistently increasing sales revenue, net income, and free cash flow for at least 5 years. Write this down, very important, for at least 5 years. In other words, over the last 5 years, I want to make sure that the business is able to grow their revenue year after year after year, consistently. Their profits grow year after year after year. Their free cash flow is increasing year after year after year for at least 5 years. Why? Because if a business can grow their revenue, profits, and free cash flow for at least 5 years, that means the business is predictable. Please write this down. Very important. It is predictable. It is consistent. And the business is resilient. So ideally, most of the companies I own are recession-proof and pandemic-proof. So even in a recession, even in a pandemic, the revenue will still grow. Got it? Now, can all companies do this? Can all companies pass the first criteria? No. In fact, I can tell you that less than 5% of stocks in the market pass my first criteria. So if you just apply my first criteria, it would eliminate 95% of all the stocks in the market already, right? So let me give you some examples right now. I'm from Singapore, and so many people like to ask me, Adam, should I invest into Singapore Airlines, SIA? Now, I love Singapore Airlines. I love it as a customer. I love Singapore Airlines as a Singaporean. I'm very proud of my national airline. It's one of the best airlines in the world. But will I ever buy shares of Singapore Airlines? No, never. Why? Because all airline businesses are lousy businesses. All airlines are lousy. It's not the fault of the management. It's just the nature of the industry. Why? Because all the airline companies fail my first criteria. So let's take a closer look at this. Let me pull out this. This is from Guru Focus, by the way. Okay. Now let's look at Singapore Airlines. Can you guys hear me, by the way? Because I think Rich is saying there's no audio. Can you guys hear me? Yeah, so Rich, do check your settings because, yep, my audio side is on. Okay, so Singapore Airlines, let's take a close look. So let's look at the revenue, sales revenue of Singapore Airlines. Is it growing consistently over the long run? No, right? You can see the revenue is going up here, then the revenue is going down, then the revenue goes up, then go down and go up. So it doesn't increase consistently. It is very, very cyclical. It goes up and down with the economic environment. We call these cyclical businesses, and I hate cyclical businesses. So that is why, for example, I don't invest in manufacturing companies. I don't invest in shipping companies. I don't invest in commodity companies. I don't invest in airlines. I don't invest in oil and gas because they are all very, very cyclical. I don't like it. It's very unpredictable. It's very inconsistent. I want something that keeps going up consistently. Understand? Next, look at the net income or the profit of the company. The sales is so high, but the profit is so low. Why? Because airline businesses have very low profit margins because there's a lot of competition. So they can't raise the price very much or they will lose business. So low profit margins because of competitive pressure, and they got very high cost of business. They have high wage cost. They have high fuel cost. They have high maintenance costs. They have to keep repairing their planes, right? So all that kills their profits. So that's why you can see very low profits. And even when their revenue increases, the profit is the same. Revenue goes up, the profit drops. What the heck? Right? And so you see the profit drops again. Then the profit goes up. Then the profit drops. Profit goes up. Profit drops. Then lose money. Lose a lot of money. Lose money. Make money. That is inconsistent. Make money, lose money, make money, lose money, make money, lose money, lose money. That's a lousy business. Next thing, when you invest in a business, one of the most important things is to look at the free cash flow. Please write this down. Very important. Free cash flow is very important. What is free cash flow? This tells you how much cash the company can generate, and after deducting the capital expenditure, what's the cash left behind they can use to pay dividends or to buy back shares or to retain in the business. Now, we want the free cash flow to be increasing consistently every year. But look at the free cash flow of Singapore Airlines. Over here, you can see that the free cash flow is like break even, and then again, slightly up, and then negative, negative, slightly up, negative, 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 slightly break even, very positive. So what does it tell you? Most of the years, the cash flow is negative. They are losing more cash than earning cash. So if the company keeps losing cash, what happens? They have less and less cash. They have to keep borrowing more and more money, or they have to keep selling new shares to get more cash. So this is the kind of business that I do not dare to buy. Although I love Singapore Airlines as a customer, but I would never dare to own the company. Yeah. So when a business is not able to grow their revenue and their free cash flow in the long run, can the share price go up? No, the share price can never sustain in the long run. So take a look at this chart. Let's put in Singapore Airlines. Now, earlier this year, people got very excited because people were all traveling again and the borders were all opening. So you can see, whoa, the share price went up. And then people asked me, Adam, should I buy Singapore Airlines? And I said, well, for me, I wouldn't dare to buy because I know that it's not sustainable, right? And sure enough, blah, 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 blah. Okay, this is over 1 year. Now, if you look at it over 5 years, let's look at it over 5 years. If you bought it here 5 years ago, after 5 years, it is still below the price you bought it at. Now, what if you go back 10 years? Oh my God, that looks even worse. If you bought the shares 10 years ago, after 10 years, you are still not even breaking even. So does this make sense, guys? All right. Now, and then a lot of people also ask me a couple of years ago, should I invest into C Limited? Have you heard of C Limited that owns Shopee? And I said, well, look at the financials. Is it a great business? So again, take a look at C Limited. Is it a great business? Okay, so this is C Limited, ticker symbol SE. And you can see again the revenue is going up. But are they making money? No, they're losing money, losing money, losing money, losing money all the way. And look at the free cash flow. The free cash flow again is negative, 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 positive, negative, negative. It's mostly negative free cash flow. So straight away, it fails the first criteria. It is not a good business to own. Now, remember, what is a business? A business is a money-making machine. The more money it makes, the more it is worth. It's as simple as that. Now, if a business doesn't make money, then what is it worth? It is worth what you think it could make in the future. So what if it never makes money in the future? Then it's worth nothing, right? And the value is purely based on your hope of the future. So personally for me, I never buy companies that are losing money. It is against my religion. All right, so write this down, write this down. Never buy companies that are losing money. Now, some people say, but Adam, initially they may lose money, but later they may make a lot of money. True, it could happen. But I can tell you that for every one business that loses money, that can make money in the future, 99 will never make money. 99 will all die. So if you buy a business that loses money, it's like kissing a frog, hoping the frog will turn into a prince. Now, will some frogs turn into a prince? Yes, but very rare. Most frogs will remain frogs. Now, if you go around kissing frogs, kissing frogs, kissing frogs, guess what? Most of the time, you end up with a dirty mouth and you get poisoned, you die. Okay? So I won't buy companies that lose money. And again, if you look at C, what happened? It dropped into the C. Look at that. So the share price go up is purely hype because it's not making money. What are you paying? You're paying for hope. You're paying for hype. And then, kaboom. Now, will it ever recover? Who knows? It depends on whether they can make money in the future, which is, again, a big question mark, right? So I don't like to buy things where I don't know. I like to buy things that I know are making money now, not I hope will make in the future. Okay? So what kind of companies do I buy? I buy companies that meet the first criteria. So one of my biggest positions, example, MasterCard. I also own Visa, by the way, right? They are both a duopoly in the payment transaction market. Now, why do I own MasterCard? Take a look at the revenue. Is the revenue in blue, is it growing consistently? Is it growing consistently over the long run? Yes or no? That's right. Even in a pandemic, their revenue goes up. Even in a recession, their revenue goes up. Everyone in the world uses MasterCard and Visa. Okay? Look at their net profit in green. Is it increasing consistently? Yes. We call this consistent. We call this predictable. We call it resilient. Look at the free cash flow. The free cash flow in blue, again, increasing consistently. And that's why if you look at the share price over the long run, let's put in MasterCard. Is the share price increasing consistently? Yes. These are the kind of businesses that I invest in. Where in the long run, the share price always goes up. Would you rather buy a company where the share price looks like this over 10, 20 years? Or would you rather buy blah, 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 like Singapore Airlines or like Keppel Corp or like all these cyclical companies, right? Another great business which I invest in is Alphabet, right? Again, this is a no-brainer. Look at the revenue, right? Revenue increasing consistently. Look at that. Net profit also increasing consistently. Free cash flow. Look at the free cash flow. Also increasing consistently. And a company like Alphabet, they have got a lot more cash. They have got more cash than their debt. So if the company wanted to, they could pay off all their debt and be debt-free. These are the kind of companies I dare to put my entire life savings into these companies because I know they can never go bust because they got more cash than debt. I can sleep soundly at night. Follow? And sure enough, if you look at the stock price, again, in the long run, look at Google, right? In the long run, it always goes up. Why? Because it generates more and more money every single year. That's why I always think of a business as a money-making machine. If it makes more money every year, it's worth more every year, the share price will always go up over time. And if it drops temporarily because of macroeconomic or political reasons, those are great times to buy. All right, so that's the first criteria. Is it useful, everyone? How many of you have gotten a bit more enlightened right now? Like, oh, now I know what companies to buy. And how many of you realize that in the past, you've been buying the wrong kind of companies? All right, so let's move on. Second criteria. Now remember, I've got 7 criteria. That's only the first criteria. Well, 7, okay? So criteria number 2, by the way, the second criteria is the most important criteria of all. It's the most important one. So write this down. Second criteria, I only invest in businesses that have a sustainable competitive advantage that protects it from competition. So competitors are not able to easily come and take away market share or easily take away customers. Warren Buffett calls this an economic moat. Now, you know what's a moat? In the old days, kings lived in castles. And how do they protect the castle from the enemy? They build a moat around the castle, which is this water barrier. And they put a lot of crocodiles and all that. So the enemy cannot attack the castle because of this moat. Same thing. Before you invest in a business, you must ensure the business has a very wide and deep moat with a lot of crocodiles so that the competitors cannot come and attack your castle. The competitors cannot come and take away your customers and take away your market share. So in other words, write this down. We only want to buy companies that have no competition. Write this down. We only want to buy businesses that have got no competition or the competitors are insignificant. The competitors are insignificant. They cannot disrupt the business easily. They cannot take away your customers. Understand? So this will assure that your business can continue to keep growing in a predictable fashion in the next 20 years. Now, what gives a company this protection? What gives a company a moat? They are altogether 5 things. 5 things. Number 1 is a very strong brand monopoly. Okay? So I like to invest in companies where the brand is so strong that people are very loyal to the brand. They love the brand so much that even if the company raises prices, customers will not leave. They are willing to pay the high prices, even though the price is higher than the competition. So for example, I invest in LVMH, Louis Vuitton, right? Now, LVMH, they raise their prices every year. Even in the pandemic, they raised the price of their bags to a few $1,000s. When they raise their price of their branded goods, do people buy less? Do people buy less? No, they buy more because it's more prestigious. The more they raise the price, the more they love it, right? So we call that pricing power. Same thing, McDonald's raise their price every year. Starbucks raise their price every year. Apple, we know that the bloody charging cable is $30. The bloody phone is so expensive, but people still buy because it's Apple. It's Apple, right? People are willing to pay for the brand. So we call it pricing power. Okay, so avoid companies that do not have pricing power. If a company has to cut price in order to maintain their market share or to prevent losing market share, that is a red flag. And that's why for me personally, I do not dare to invest in Tesla because I think Tesla, they don't have that pricing power. They have to keep cutting price in order to maintain the market share. And there's so much competition coming from, you know, BYD and all these other things, right? So next thing, I like to invest in companies where the brand is so strong, it becomes a top of mind recall in people's mind. It's a brand monopoly. So when people think of the product, that's the first brand that they think about. Okay? So let's play a game for me to illustrate this point right now. Now, if I mention office software, whether you're working from home or you're working in the office, you have to use software. What do you think about? Microsoft. Microsoft is a brand monopoly. Microsoft has got no competition, right? That's why Microsoft is one of my biggest positions. Look at Microsoft. When a company has no competition, they just keep growing for the next 10, 20 years. These are the kind of companies I want to own. It's a brand monopoly. Okay. Now, wherever you are in the world, whether you're in Singapore, you're in Malaysia, you're in Europe, you're in the US, you're in Canada, it's early in the morning, it's late at night, you're hungry, everything is closed, but there's a fast food restaurant somewhere a few blocks away. That's right, McDonald's, right? McDonald's is a brand monopoly. I own McDonald's. I sold it early, I bought it back recently, right? Look at McDonald's. Again, McDonald's is a brand monopoly, and you can see over the long run, it always goes up. These are brand monopolies. Now, every day we have to search for information. When you think of search, what do you think about? This, again, is a no-brainer. Google. In fact, what do we say? Google this, Google that. It's become part of our vocabulary. Google is a monopoly. They control over 92% of the search market, right? Again, look at Google. Long term, it always goes up. Long run, it always goes up. So only invest in brand monopolies. Okay. Now, what else besides a brand monopoly? What else gives a company a moat, a protection? The second thing is what we call high customer switching costs. Very important. Please write this down. High customer switching costs. Write this down. Very important. Now, what does this mean? It means that once a customer uses the product, it becomes very expensive or very inconvenient for them to switch to another company, to another brand. So they are stuck with the brand for at least the next 5 to 10 years. We call it stickiness. Yeah. So I like to invest in businesses where the customer is stuck to the business for at least 5 to 10 years and they earn recurring income. Write this down. Recurring income. That means every month, every year, you have to keep paying for the service. All right. So what are examples of companies that have high switching costs? That once you use it, it's very hard to not use it. You have to keep using it again and again. Right? Apple. That's right, Apple. Now, if you think about it, Apple makes phones. Don't they have a lot of competition? Samsung makes phones, Xiaomi makes phones, correct? Apple makes tablets, everyone makes tablets. Apple makes computers. There's so much competition. So what gives Apple the advantage? It is not the phone. It is not the tablet. It's not the computer. What gives Apple their moat is the ecosystem that they have built, where all their devices, they sync seamlessly, they work together, sync to the iCloud. That is the moat, right? So, like, I'm an Apple user, and I've got my Apple Watch, I've got my iPhone, I've got my MacBooks, I got my iPad, I got my AirPods. Everything syncs to the iCloud. And every month, I've got to pay for the iCloud subscription, right? And it makes my life so convenient. If I love a song, I download the song into my phone. Straight away, the song is in my watch. If I go jogging now, I put on my AirPods, I can listen to the song. If I do my work on the computer, straight away it appears on my iPad. Everything is synced together. Okay. Now, would I ever buy a Samsung phone? Even if Samsung had a phone that was cheaper, more features, more beautiful, will I buy it? No, I'll never buy a Samsung phone. Because if I buy the Samsung phone, it can't sync to my Apple Watch easily. It can't sync to the iCloud. It makes my life very inconvenient. So because of that, I will only buy Apple products. I'm stuck in the ecosystem. It's like Hotel California. You can never leave. Bastards, right? I always complain, Apple, the things are so expensive, bastards. But I still buy it because I'm stuck. I can't leave. Oh, right? But that's why I love Apple. That's why I bought Apple, right? So look at Apple. Apple. Boom. Long run, it always goes up. It's a Hotel California. Once you check in, you can never leave Apple. Okay? Now, in general, I love software companies because most software companies, they have got high switching costs. Once a company uses a certain software company like Salesforce, like Tyler Technologies, like ServiceNow, like Adobe, once a company uses the software, it costs millions to install the software, to train people to use the software, and they will not change it at least for the next 10 years. And so they got recurring income, and that gives them a moat, right? Even cybersecurity companies, for example. So again, if you look at ServiceNow, I own ServiceNow, look at that. Always goes up in the long run, right? Tyler Technologies, which is for the government sector, always goes up in the long run. Adobe, again, these are all high switching cost companies, right? They lock in the customer for at least 5 to 10 years. Do you follow so far, guys? Is this useful? Okay. Let me share a bit more. Now, besides brand monopoly and high switching costs, what else gives a company a moat? A network effect. What does a network effect mean? It means that the more people that use it, the more people want to use it. Because everyone is using it, I have to be there, right? Example, Meta. Meta owns Facebook, they own Instagram, they own WhatsApp. Now, if you are an old guy like me, or you're in Asia, you have to use Facebook. You have to, because everyone is on Facebook. If you're young, like my kids, you have to use Instagram or Insta, because everyone's in Instagram. If you have to use WhatsApp because everyone's on WhatsApp. You can't live without it. So they have built this network effect. Okay. Amazon, same thing. If you're selling something online, you have to be on Amazon. Why? Because everyone's on Amazon. You gotta be there. It's called the network effect. So this creates a moat, right? High barriers to entry, huge economies of scale, protect them from competition. So for me, listen very carefully. I only buy a business if it has got at least 2 to 3 of these moat characteristics. Then I'm confident that my company cannot be attacked by its competition. They are protected for the next 10 to 20 years. And the share price will keep going up. Now, again, there are a lot more criteria I look at. I can't cover them all in detail. If I do, it'll take about 26 hours. Why? Because that's how long the value momentum investment course is. When you take the value momentum investment course, they are altogether 12 lessons, and it's over 26 hours of training. And you get a lifetime access to all the videos. There's no expiry date, and I update the videos regularly, right? So that's where I go into detail into every single thing, right? But just to briefly share with you, I also buy companies that have huge growth potential, that they are catalysts that will drive growth into the future. That's why I own semiconductor companies. I think there's huge growth in semiconductors, in cybersecurity, in healthcare, in e-commerce. Okay. Next, I also like to buy companies that have conservative debt and a lot of cash, so that even in a recession, I am not concerned. You see, in a recession, companies that have got very low debt and a lot of cash, they are not going to be in trouble. If interest rates go up, companies that have low debt, they don't have to pay more interest to the bank, right? And in the bad recession, good companies become stronger. Why do they become stronger? Because many of their competition will die, and they're able to buy up the competitors. They get stronger after every recession. So in a way, I love recessions because recessions help me to further wipe out the weaker competition, and the company that I own gets stronger and stronger and stronger. How many of you feel that so far what you've learned is going to help you to become a much better investor? Great. use it. Use this knowledge. It is very, very powerful. But I can tell you that what I've shared with you so far is just the tip of the iceberg. It's less than 3% of what you're going to learn in the course. And when you take the value momentum investment course and you learn everything, you're going to have the confidence to manage your own money. You're going to have the confidence to achieve double-digit returns from the market and to achieve your financial goals, even with all the bad news. And you no longer have to listen to these financial experts. You can do it yourself. Okay? So let me share a bit more about the investment process. Now, again, remember, we only want to invest in the top 1% of companies in the market. The top 1% of companies, they make more money every single year, right? And again, remember, a business is a money-making machine. The more money it makes, the more it is worth. So a great business, you are confident that every year, over time, it will keep increasing in what? It will keep increasing in value. So this green line that you see, this is called the intrinsic value. Understand? So if you buy the share today at today's price, you are 99% sure that the price will be higher in the future because the business is worth more, because the business makes more money. But do you think that the share price will go up every day, every week, every month, every year, in line with the business value? Yes or no? Does the share price go up every day, every week, every month, every year in line with the business value? No. So remember that in the short term, the stock price is not always driven by the value of the underlying business. But in the short term, the stock price is driven by emotions, by manipulation, and by news. So in other words, a business, if let's say there's a lot of good news, there's a lot of hype, the share price can, be driven way above the value of the business. And that's when it gets overvalued, right? But then the opposite can happen. If there's bad news, oh my God, the recession is coming, the high interest rates, and there's fear, there's panic, there's manipulation, the share price can go way below the actual value of the business. And then the cycle repeats, right? And then good news again, good news. Oh my God, bad news. Good news, bad news, good news. And that's what happens every day in the short term. We've got volatility that drives the price up and down like a yo-yo. Now, as an investor of a great business where the value keeps going up, company makes more and more money every year, do we like short-term volatility? As an investor, do we like short-term volatility? Yes or no? Yes. I love volatility. Why? Because volatility creates the short-term mispricing of the business. I repeat, write this down. Volatility creates the short-term mispricing of the business. In other words, a business that is worth $300, for example, could temporarily be selling at $150 because of panic selling, because of manipulation, because of bad news. So that's when you get to buy a great company at half price. That's when it is undervalued. It's like buying a Ferrari at the price of a Toyota, but it doesn't last for very long. That's why you have to be very fast to take advantage of the mispricing. Okay? Now, at the same time, a great business that's worth 300 could temporarily be selling at 500 because of hype, because of all this FOMO buying, right? So that's when we say it is overvalued. By the way, does this happen often? Does a Ferrari sell for the price of a Toyota often in the stock market? Yes or no? Yes, it actually happens. Well, I wouldn't say it happens very often, but it happens once in a while and enough to make you rich. Like, for example, look at Meta. Again, I love the Meta example. Meta that owns Facebook and WhatsApp, if you calculate the intrinsic value, you would know that the shares are worth at least $350 to $400. Okay, I repeat, Meta is worth at least $350 to $400. But last year, because of the panic selling and the manipulation, it was selling at $80. Think about it. Meta was selling at 70% discount. But many fund managers didn't dare to buy. Many fund managers were selling it because they were short-term focused. They were afraid, when it goes lower, when it goes lower. But then we as smart investors, we think logically and not emotionally. So last year, I was buying Meta. My students were buying Meta at 50, 70% discount. And that's how this year, Meta is one of my biggest positions. Okay? So you tell me, as a smart investor, when is the safest time to buy a stock? Do you want to buy over here? Let's call it area A. Or do you want to buy over here? Let's call it area B. You tell me, A or B? A or B, guys? All of you say B. All of you say B. But is that what you do? I hope so, okay? Because I can tell you that most retail investors who are not trained in investing, guess what? Most people, they always buy at A. They always buy when it's overvalued. And I can tell you that most retail investors, they always buy somewhere here, near the top. Why do they do that? Because most investors, they buy and sell based on emotions, not based on numbers and facts. You see, a lot of people, what happens? When they see that the stock price keeps going up, the price goes up, goes up, goes up, goes up, goes up. They see everyone making money. Everyone gets excited. They get excited. So by the time they buy, the price already went up. And they are buying it when it's already overpriced. So sure enough, after they buy, yes, it may go up a bit more, but sure enough, it will start to drop. Then when it drop, everyone panic, everyone sell. They see everyone panic, they panic, and they sell as well. So they end up buy high, sell low, buy high, sell low, buy high, sell low, and they always lose money. How many of you this has happened to you before? How many of you, every time you buy a stock, it drops? And after you sell it, later you see, it went up. Okay? Now, if that has happened to you before, it's not because you are unlucky. It's got nothing to do with luck. It's not because of your 八字. Okay? It's not because the market gods hate you. It's because you are buying and selling based on emotions. And a lot of people, they also buy and sell based on reading the mainstream news. So what happens? After the stock or the market goes up, the media will always release good news. Oh, the company is doing well. The company has a record profit. So when you read all the good news, you get excited, you get confident, you buy the stock, you're always buying it at the freaking top. Then after the price drop, the media will say, oh, the price dropped because of fear of inflation, because of high interest rates, because the company is did not meet expectations. Then you read all the bad news, oh my God, and you sell. And again, that's why you always buy high, sell low, buy high, sell low. That's why you always lose money. Okay? So if you want to achieve consistent profits, like me, like my students, all right, and you want to beat the market, you want to beat 90% of fund managers, you have to train yourself to go opposite of everyone else, which means you want to buy when a great company is undervalued. But let me ask you this question. When is a great company undervalued? When there's good news or bad news? When there's good news or bad news. When there's bad news. When there's fear or there's optimism. When there's fear, right? So whenever you read bad news, whenever there's panic, that is when you should be buying. But remember, only buy the top 1% of companies. Don't buy the 99%, because the 99% are not good companies. They will drop and never come back. Only buy the good companies. Okay? You follow so far? So right now, are there still Ferraris selling at Toyota prices? What do you think? Are there still great companies that are still cheap? Do you think in today's market there are? Yes, there are. There are still quite a lot of opportunities. So example, one of them that is so obvious, recently it was reported that two very big super investors started buying as well. Can't remember their names, right? But I've been holding it for quite a while. Google, Alphabet. It's so obvious. Every one of us uses it every single day, okay? Now, again, is Google a great business? Yes. It passes all my criteria of a great business, okay? And you can see the intrinsic value increases over time because the business makes more and more money every single year. It's a no-brainer, right? But does the share price go up in a straight line? No, look at the share price. Good news, bad news, good news, bad news, good news, bad news, good news, good news, good news, bad news, good news, good news, good news, good news, bad news, bad news, bad news, all good news. So once there's bad news and the price goes below the intrinsic value, this is the buy zone. This is the buy zone. Now, of course, some of you are asking, how do I calculate the intrinsic value? That is the most important ingredient of my secret sauce. Right? That's in the value momentum investment course. So again, if you take the course, which is on over 60% discount today, go grab the offer. It's only once a year offer. You will learn, I'll teach you in the course exactly how we calculate the intrinsic value, and you get my intrinsic value calculator that helps you to do it very, very fast. Okay, so I'm going to show you right now. This is the intrinsic value calculator. Okay, so all you got to do, by the way, once you enroll today, you can download the calculator immediately and you can start to learn to use it. All you got to do is to key in the boxes in white. Now, where do you get all these numbers from? You can get it from any free financial website like Yahoo Finance. It's all there. Just key it in. Simple. It takes less than 10 minutes. In fact, I take 5 minutes. But if you're new, maybe you may take 10 minutes, right? So for example, key in how much free cash flow the business earned in the last 12 months. 77 billion. There we are. Okay, key that in. How much debt does the company have? 13 billion. How much cash do they hold now in their bank? 119 billion. Excuse me. And then you put in the growth of the company. The next 5 years, the company is projected to grow at 15%. And then the following 5 years, I conservatively cut it to 7% growth, and then finally 4% growth. Total 12 billion shares outstanding. So put in all these numbers and you can see what's the intrinsic value. Ta-da! $118. So once you value the company, you know exactly what the shares are worth. $188. So what is the share price today? Let's take a look at the share price today. So currently the share price is $135. 135. So if you buy it at $135, you're still getting a 28% discount to the fair value of the company. Is that a good deal? Still not bad, right? Correct? Still not bad. Let me see if I can find the Meta one. Hold on, give me a second here. I don't know where I kept my Meta valuation. I may or may not have it. No, I don't think I have it in this computer. Anyway, like I said, Meta is roughly $350 intrinsic value, $350 to $400. And again, if you look at my Meta, let me show you. Right now it's offline, but okay. Like you can see over here in this account, my Meta, my profit so far is $108,000 US on Meta on this account. My second account, my Meta is $97,000 US. That's the unrealized profit. So 97,000 plus 108,000. How much is that? 97 plus 108. My total profit on Meta is $205,000 US. Right. And so far, my Meta position is 219 plus 116. Is it 116? Sorry, 219 plus 213. So it's about, I've got about 432,000 US on one stock. And my profit alone is 200,000 in one stock. And am I selling it? No, because I think that Meta at 335 is still cheap. I think it's still very cheap. And not only that, but I think Meta's intrinsic value will grow exponentially as they monetize their WhatsApp, as they have a lot more AI features. So I think they could easily, in my opinion, right? Again, I could be wrong, right? But in my opinion, I think it could easily double to $800 per share in the next couple of years. So great company, I'm still holding it. And in the short term, if there's any panic and drop, I'll buy more, right? So Meta alone, I know I can make at least $1 million US profit just on one stock, okay? And how do I have this confidence? Very simple, is because I look at the numbers. I look at my valuation, right? So again, when you enroll in the value momentum investment course, you get all these spreadsheets, you get all the intrinsic value calculators, you get the detailed lessons on how to do all the valuations. Yeah. And if you subscribe to the UIP, which is the Ultimate Investors Playbook subscription, I will do all the valuations for you every month. Every single month, I will calculate the intrinsic value of all the top 1% of companies in my portfolio, in my watch list, and you get access to all my research every month that's updated. Okay. Now, I do not just look at the fundamentals of the business and the intrinsic value alone before buying a stock. Before I buy, I also look at the technical chart patterns to identify the optimal entry and exit prices. So would you like to know a bit about how I read charts? Right? Now, I know some of you have got some questions on ARM and all that. Do post your questions on the Q&A tab, and I will answer the questions during the end of the webinar, which is going to come soon in the Q&A session. Yeah, so hold on to that, but let me teach you a bit more. So let's look at the chart of Google. Now, again, remember, when you buy a great business, the stock price will always go up, at least for the next 10 to 20 years. Okay? But does the stock price go up in a straight line? No. The stock does not go up in a straight line. It moves in wave patterns like that. Always remember wave patterns. Wave up, wave down. Wave up, wave down. And the pattern repeats. is kind of like breathing, a breathing pattern. Breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out. Now, no matter how strong you are, can you breathe out forever? Can you go, no, right? You run out of air. Eventually, your face will turn blue, right? You have to breathe in before you can breathe out again. So same thing with a stock. The price can't go up every day, every week, every month, every year, right? After a wave up, it has to wave down before waving up again. So you tell me, as a smart investor of a great company, when do you want to get in? Do you want to get in after a wave down to A, or do you want to get in after a wave up to B or to C? You tell me. A, B, or C? For me, I want to get in after a wave down. Write this down. I want to buy after a wave down to A. Because if I buy at B or C after wave up, yes, I will still make money eventually, but I would probably have to wait for another wave down before the wave up goes higher. So it take me longer to get the returns. Understand? I rather buy on a wave down. Now, people ask me, Adam, how do you know is the bottom of the wave down? How do you know it's the point A? How do you know after you buy, it won't go lower, right? So the thing to understand is you will never know the bottom of a wave down. You will never know the exact bottom. Now, must you buy at the exact bottom to make money? No. So even if you buy here and it goes lower a bit, right, or here, it doesn't matter, because eventually when it waves up, you're going to make very big returns. So as long as you buy near the bottom is good enough. As long as you don't buy near the top, you do very well. Now, the question is, how do you know when it's near the bottom, right? So what I do is I look at historical patterns of support. I repeat, I look at historical patterns of support using moving averages. So again, in the course, the value momentum investing course, I don't just cover the fundamentals of analyzing the business and intrinsic value. I cover a lot on the technical analysis, reading the chart patterns. So these are my moving averages. Let me put it in. Ta-da! Okay. So can you see these colorful lines? These are the moving averages. And notice something interesting. Okay. So again, if you look at a stock, it would have shallow wave and deep wave. Okay, watch, huh? Shallow wave, shallow wave, shallow wave, deep wave. Shallow wave, shallow wave, shallow wave, deep wave. Okay. Can you look at the wave patterns on Google? Watch this. Wave up, wave down. 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 These are all the shallow waves. We call them pullback and corrections. Now notice during the shallow wave, where does it bottom? Where does it find support? It finds support at the red dotted line. Can you see? The red dotted line is the 20 EMA on monthly candles. So every time it waves down, notice when it gets near the red line, it will bounce off, right? It goes out, doing, 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 doing. You see that? And then if there's a recession, there's a bear market, what happens? You get a big wave down and it will hit the blue line. The blue line is the 50 moving average on monthly candles, and then it will bounce, right? So this will breathe out. After a big breathing out, usually you have a big breathing in. So yes, last year we had a bear market, so another big wave down. So my students and I, where were we watching? We were watching the blue line. The blue line. So the moment it hit the blue line, the 50 moving average, we know we can start buying. Because historically, it's a very strong support. right? So that is the point A. So now you can see it is already gone up halfway to the top. So it will still go. Okay, let me push it a bit to the right here, so you can see. A bit to the right. Okay, so right now you can see over here, right? Wave up, wave down. Now we are halfway up. Now, right now, we will still go up somewhere here, right? And then we're going to wave down again, right? So we are still halfway to the top wave. We're halfway. We're still at a 35% discount. Of course, if you bought last year, then you get like a 50% discount. Okay, but now it's still within the reasonable buy zone. Okay, now again, there are many stocks that are still at 50% discount. Many, all right? In fact, a lot in the healthcare sector. We'll discuss a lot more about this in the webinar when you join the community, okay? The great thing is once you join, not the webinar, sorry, once you join the course, you'll be in our chat group community. It's a lifetime membership where I'll be there with you in the chat group 7 days a week, 18 hours a day, where we will share all these opportunities, right? Is it useful so far, guys? Okay, cool. So let me summarize what you're going to learn in the value momentum investment course, okay? So the first thing is you're going to learn how to identify and pick the fundamentally strongest stocks in the market, whether it's the US market or the India market or the China market or the European market. How do you identify the top 1% of companies that meet all the criteria? Second step, once you do that, you will learn how to calculate the intrinsic value. So you know what is it worth? What's the intrinsic value? And be patient, buy only when it is undervalued, right? And buy near the support level after the wave down and to catch the wave up, okay? Then what's step 3? Step 3 is you will then learn how to build a low-risk, diversified portfolio. So remember, never put all your money into one stock. Always divide your capital into minimum 8 to 10 great companies. So that even if 1 or 2 stocks, shit happens in the short term and the price drops, like the Disney or the Alibaba or the what's the other one that dropped recently? Yeah, can't remember, okay. Or Boeing, right? Even if it drops temporarily, it doesn't matter because your other 7 to 8 companies will pull your portfolio up, right? And buy you time until those 2 or 3 shit ones rebound, okay? So in the course, you're going to learn that when you build a portfolio, now, by the way, even if you're investing $1,000, don't put it into one stock. Even if you're investing $1,000, divide it into at least 8 to 10 companies. That means each stock $100 allocation. Now, the great thing is many stockbrokers, like Interactive Brokers, they allow you to buy fractional shares. That means you can buy less than 1 share of Microsoft. You can buy less than 1 share of Meta. You can buy 0.1 share or 0.01 share. So even if the share price is more than $100, you can buy $100 worth of any stock. So you can build an equal portfolio. Understand? That's what's great about it. Now, you also learn in the course that when you build a portfolio, don't buy all the same types of stocks. Like, don't buy all 10 technology stocks. Because like last year, when all the tech stocks dropped, your entire portfolio dropped. You have to ensure your portfolio, you have got a good mix of technology stocks, of healthcare, of communication stocks, of financial stocks, of consumer discretionary stocks. So it's balanced. So that in any market condition, if tech stocks go down, your healthcare stocks will pull it up. If like this year healthcare goes down, your tech stocks will pull up. So you need to have a good balance so that your portfolio will remain resilient in any kind of condition. Does this make sense, everyone? Yeah. You also learn in the course that there are 8 different types of investment styles. So for example, in your portfolio, you may want to buy more of the growth companies that will grow your portfolio, but at the same time have some predictable defensive companies that are recession-proof. So for example, if we get hit by a recession next year, the defensive stocks will protect your growth stocks. You must learn to balance the growth and the defensive stocks, so the recession won't affect you that much. Yeah, we'll cover all this in detail in the course. So example, I own McDonald's, I own Hershey's chocolates, I own like Domino's Pizza, okay? So these are more defensive companies that will tend to be more recession-proof, yeah? And then you can have some more speculative growth stocks like Palantir that can, double, triple, okay? And then some of the ETFs and turnaround companies and dividend companies, right? Some stocks just to pay you dividends. So you need to have a good mix of the different types of companies to create what we call a bulletproof portfolio. And step 4, you're going to learn in the course exactly when to sell. What are all my selling rules, right? How do you know when a business is no longer great? Get out, reinvest it in a better company that can grow. Or a great company is way overpriced. Get out, take the money, buy something else just as great, but more value. Or buy back that same stock once it gets cheap again. Okay? So we'll cover all this in detail. And of course, a lot more, right? So like I said, today I've only got about 2.5 to 3 hours, and I want to do my best to, teach you as much as I can. But there's only so much that I can squeeze into your brain in 3 hours, right? And that's why we have the course that's over 26 hours that you will learn at your own pace, and you get all the tools, all the calculators to make sure you make the best investments. Okay. Now, if you follow all the rules I've talked about, even with recessions, even with bear markets, can you still grow your wealth consistently? Yes. All right. Every year, I show my results to my students. They see my track record, and I show my results to the public as well. I publish it on Facebook, on YouTube. And let me just show you the last few years of my portfolio returns. So 2019, my portfolio was up 47%. You can see there's the one in blue, that's mine, versus the S&P 500. And then in 2020 was the COVID recession. Most people lost money that year, but I made 44% return in this portfolio, 41% return in this portfolio. My total profits for the year was $791,000 US. Now, this doesn't include my dividend portfolio, which is in the Singapore stocks, right? If you include that, it's way over $1.3 million. Yeah. 2021, this portfolio was up 23%. This one was up 10%. Now, this one was actually a very low return because this portfolio had most of my China stocks, right? So my China stocks like Alibaba, Tencent got hit in 2021. It dropped a lot. So it put on the portfolio. But even then, I still managed to make a bit of money, 10%, right? Better than nothing, right? In total, I made about 400,000 US in 2021. Now, last year, you guys know what happened. I published my results on Facebook, on YouTube. Last year, we had a bear market. So yes, my portfolio dropped last year, 20+% last year, right? But this year, it all rebounded, right? And so far, in the last 4.5 years, let me ask you this question. In the last 4.5 years, was it an easy market? I can tell you that in my career of investing, the last 4 years was one of the most difficult. Because the last 4 years, we had 2 bear markets. We had a recession. We've got Ukraine war, now Middle East war. We had super high inflation. We had super high interest rates. We had all the bad shit, right? But despite that, if you look at my portfolio from January 2019 to November now, my portfolios are up 129.9%, which is close to 130% return, beating the market and beating over 95% of fund managers. Is it because I'm very smart? No. Is it because I can see the future? No. It's because I have a lot of discipline. I invest based on facts and numbers and statistics, not on emotions and not on reading the financial media, right? And if you look at my students, many of them have way outperformed me because I'm very conservative, right? And many of my students are a bit more aggressive than me, which is fine because some of them are younger. I'm older, so I'm more conservative. And many of my students have done even better than me. And I'm really proud of that. So I know that you guys can do very well. I know that you guys can beat these so-called experts. You guys can beat the market if you just follow these rules. Yeah. I'm not smarter than most people, I can tell you that. But one thing I can tell you, I'm very, very disciplined. I'm very, very disciplined. All right. So question, right now, do you think it's a good time to invest? Yes or no? Is it still a great time to invest? Well, let me share with you where I think we are in the markets right now, okay? By the way, we're coming towards the end of the webinar, so very soon we're going to have the Q&A session. And again, take advantage of our crazy discounts, 60 to 70% discounts off my courses and my mentorship playbooks that, happens once a year during the Black Friday sale. So, grab it. I know some of you have been waiting 11 months for this. So, make sure you grab it before it's over, yeah? Okay, so remember, the stock market always goes up in the long run, but it doesn't go up in a straight line. It moves in cycles like that. Okay, so the market moves in cycles, and it moves in what we call uptrend periods. This is called an uptrend. Or we call this a bull market, right? We call this a bull market. Okay, this is called a bull market. And then we've got periods of downtrend. Downtrend, all right? And what we call this, everyone? We call this a bear market. That's right, right? So the market always goes through bull, bear, bull, bear. It keeps repeating again and again, okay? Now, where are we now? Now, I want you to look at this chart and roughly kind of like point, where do you think we are now in this cycle? Where are we right now in this cycle? So the answer, right now, we are somewhere here. You are here, we are here right now. Okay. Now, last year, 2022, we were in a bear market, as you guys know, and the bear market bottomed in October last year, October 2022. That's when the bull market started, right? So from October last year to now, we are now roughly about 1 year into the new bull market. So a lot of people ask, is the bull market over? It's already 1 year? How long does the average bull market last? If you look at history, the average bull market lasts at least 5.5 years. About 5.5 years on average, right? So in other words, if this is a normal cyclical bull market, we are in the first part. We have got at least another 4 more years to go in this bull market. That's why right now, companies like Google are still selling at 30%. So you can still get very good opportunities now at the beginning of the bull market. But if you wait another 3 months, 6 months, 1 year, 2 years, then it becomes more and more difficult to buy great companies at discounts. You'll no longer be in a discount anymore in the next few months. So now's the time to learn. Now's the time to take massive action. All right. Now, if you attended my earlier webinar in July during the 6th wave event, did you guys attend that event, the 6th wave? Right? So in that event, I said, we are not only in a cyclical bull market, we are in a secular bull market. Secular means we're in a longer term bull market driven by technology revolution of AI and automation. So let me show you the next slide and why I'm so excited about the future. Okay. Now, if you look at the very long term, give me a second. Hold on. Let me see why this looks a bit odd. Yeah, okay. Now, if you look at the very long term of the stock market, you can see that we started a secular bull market in 2013. Okay, this is called a long-term secular bull market. Now, the secular bull market lasts about 20 years and is driven by a technological revolution. So the last secular bull market from 1980 to 2000, that was driven by the internet revolution, when the internet was invented. And this was the entire 20-year bull market. Then we went into a 13-year secular bear market. And then in 2013, we started the new secular bull market. As of now, we are in 2023. So we are 10 years into the new secular bull market, which means that we are halfway. We have another 10 more years to go in this secular bull market. And that's when you want to build your fortune and retire and be financially free in the next 5 to 10 years. Okay. Now, notice something. In this secular bull market, you got 2 bear markets, 1, 2. Can you see? Bear market 1, bear market 2. Here, secular bull market, bear market 1, bear market 2. So every secular bull market historically had 2 bear markets. Now, in 2020, we had 1 bear market here. And last year, we had the 2nd bear market. So in my opinion, we have already finished the 2 bear markets, and we should not have another bear market for at least the next 5 to 10 years. Now, again, I could be wrong. I can't predict the future exactly. That's just my opinion. And that's why I continue to be very excited about the future. Okay. But of course, if you listen to all the prophets of doom every year, they tell you that we're all going to die. All right. So let me now introduce you to the value momentum investment course. I've been teaching this class since 2005. So it's been 18 years I've been teaching investing. But it was in 2016 that I launched it online, right? Before that, you could not learn it online. You had to travel all the way to Singapore to learn it offline, right? So in 2016, we launched the Piranha Profits online investment trading school so that everyone in the world can now learn from the comfort of your home. And this course was launched online in 2016. This is the value momentum investment course known as the Whale Investor course. So this course is an on-demand course. So what that means is that you can watch it anytime, anywhere, and you will have a lifetime access to all the videos. And I update the videos regularly every year to give you the latest examples, to give you the latest strategies. So in other words, there's no additional charge for future updates. It's a one-time enrollment for a lifetime of updates and access to this course. So they're altogether 12 lessons. And by the way, just to share with you, people from all walks of life take this class. Roughly, I would say 1/3 of my students are beginners. They have never invested before in their life. They've never bought a stock before. If you are a beginner, like I tell many of my students, it is not a disadvantage. In fact, in many ways, it's an advantage. Because as a beginner, you have got no bad investment habits. You don't have any preconceived ideas about investment that sabotage you. And you don't own any lousy stocks, right? You start with a clean slate. You learn everything the right way. So from day one, you buy great companies, you make the best decisions, and you grow your wealth from day one. Then another 1/3 of my students have been investing before. Some of them have invested for many years, and some of them tell me, Adam, I've lost money for the last 7 years. Another guy told me, Adam, I lost money for the last 20 years. And I took this course because I want to learn how to make back all my losses and start to grow my wealth. And they do it after this course. They make back all their losses and they start to grow. And they learn to get rid of their lousy stocks and replace it with great companies. Another 1/3 of my students are already doing very well, making a lot of money. And I say, why do you take this class? They say, because we want to learn even more strategies. We want to learn a better way of getting results. So I have a lot of, in fact, I have a lot of fund managers who are now starting to take this class. In fact, I have a lot of stockbrokers, a lot of bankers, a lot of analysts that have taken the class over the last 18 years. Okay. Now, if you go to my Facebook page, I publish many of my students' results, testimonials. If you go to my YouTube, a lot of them share on video how their investment results have transformed after this class. Okay, so this is Anthony, who is a very, very active participant in our community. So I appreciate him a lot. He, in fact, helps me to help to answer a lot of questions as well to a lot of the new students. And this was posted a few weeks ago. He said, I'm very proud to say that my portfolio is up 52% year to date. I told you, most of my students are actually getting better results than me. I'm up 34%, he's up 52%, okay? And he said, despite holding Alibaba, Tro, and Fortinet, which have not yet taken off, I'm up 52%. This reiterates Adam and the Piranha Profits team point to stay invested and ignore the noise. Thank you, Adam and team, for your guidance. I'm truly grateful, all right? This is Tommy as well. He said, I remembered I didn't listen to you during the COVID outbreak. I shorted the market and ignored your advice. Eventually, I was beaten up. But this time, even when the war breaks out, I decided to ignore all the news and I confidently traded long on the fundamental top 1% of stocks, companies, and I'm up 34% year to date as well. And these are my other students. Javier, thank you, Mr. Koo, for taking your time to teach us all your secrets to becoming a great investor. This is Joel. I agree. If not for me, for Adam's teachings and mentorship, I will never make any real profits in the long run. In fact, I will lose money and never understand why some people could be successful in investing. All right. This is Tony. He said, here's my progress. Started July, but finished your course in November. This is from investments. Total realized gains, 120,000. Total gains for 8 months, 27%. I also switched to options and trading recently. Your courses are worth their weight in gold. I'm 38 and want to retire by 55 years old. This is Gina from the US. She said, just after a few months, I decided to take the whale investor course. Since then, I got a 60% return year to date, all right, and 40% this year. And this is Eric. I'd like to share with you what he wrote. He said, I started watching Adam about 3 years ago after losing 70,000 on Bitcoin. My net worth at that time was $750,000. I've spent about 3,000 on several courses with Adam. A year ago, my net worth peaked at $2.2 million. But now it's about 1.8 million because in last year, the bear market, his portfolio dropped temporarily, but now it's bounced back up, right? I made 2.5 times my wealth in 3 years. I don't really care that my net worth decreased in 2022. It was only a paper loss. And indeed, he has regained that, right? I do care about the 150% gain with just my 3,000 investment. Anyone can say what they should have done in the past. Why do I show this to you? Because some people ask me, Adam, if I invest 3,000 or 2,000 in your course, can I make the money back? You can ask all my students. It's not about making the 3,000 back. It's about making it back 100 times or 1,000 times. My students, once they acquire the knowledge, they're able to make a few $100,000, some of them a few $1 million. Because once you learn this skill, no one can take it away from you. For the rest of your life, you know how to make money consistently from your investments. It's an invaluable skill. That's why I tell people, the greatest investment you can make is an investment in yourself first. So please, before you buy any stock or any investment, invest in yourself. Because I can guarantee you, whatever investment you put in yourself is a 10x, 100x, 1,000x return. Okay, that's what all my students say. This is Oscar from Sweden. He said, "Hello, Adam, buying this course." Excuse me. All right. He said, "Hello, Adam, buying this course was one of the best decisions I've made in my life. Last year, I didn't have a clue what I was doing in the stock market. I ended 2018 with my portfolio down 17%. Poor guy. Early January, I bought this course, and at the moment, up 43%. Just want to give a big thanks to you for the value that you provide in the course." Right? And I can go on and on, but I won't. Right? You can read all the hundreds and hundreds of testimonials that my students have shared over the years. Now, again, common question is, Adam, how much do I need to get started investing? Do I need a lot of money? No. Like I said, even if you have got $1,000 to invest, even if you have 500 to invest, start. Because if you don't start investing with small money will never grow into big money. You got to start somewhere, right? I started very small myself. I started at the age of 17. I'm now 49. So I've been in the markets for over 30 years. And when I first started, again, it was very small. But over the years, I grew it to now over $12 million, right? And you can too. You can build a multi-million-dollar nest egg. It can happen, you know? And the earlier you start, the more time you have for your money to compound. The earlier you start, the faster you're going to reach your first $1, $2, $3, $6 million. All right. And you have more time for your money to grow exponentially. I'd like to share with you my last two student sharings. This is from Kedar, who is my first student from Nepal. And after the class, he got 80% return. This was back in 2019. He took the course in 2018. But he said over here, he said, this year I got 80% return, but from 2011 to 2018, I lost everything, 100%. I wish I had known you around that time. I lost 7 years of my life. The most common complaint I get from my students is, Adam, why didn't I take this class 5 years ago, 10 years ago? Today, I'll already be retired financially. But I say it's not too late. Better late than never, right? This is Luksat from Thailand. He said, thank you so much. This is one of my accounts. Pretty much all my accounts are good like this. I've made back all my losses in the last 20 years. How many of you have lost money before because of bad investment decisions? How many of you? Right? If you have, you are not alone. Many people have lost money before. Me too, when I first started. When I first started investing at 17 years old, I had no idea what the heck I was doing. I made all the stupid mistakes that most investors make. And I'm not shy to tell you, for the first 8 years, I went in circles. Whatever money I made, I lost it again. Because I made it from luck and not from skill. I made it, I lost it, I made it. For 8 years, I went in circles. But I didn't give up. I kept learning from my mistakes. I kept learning more and more about how the markets work. I learned about how to read charts. I learned about how to read businesses. And once I finally understood the game, then in the last 20 years was how I built my fortune in the stock market, right? So I'm here to tell you that it doesn't matter how much money you've lost in the past. It doesn't matter how many mistakes you made in the past, because the past, your past does not determine your future. Your future depends on what you do now. And this moment is a new opportunity for you if you grab it. So it's the actions you take today, it's the strategy you employ today, it's the decisions that you make today that will determine your financial destiny. You know, some people ask me, Adam, must I take your course to learn how to invest the right way? Can I learn it on my own through trial and error? The answer is yes. You can learn it on your own. You don't need me. You can do it yourself. But I can tell you this, if you learn it on your own, it will take you at least 5 years of losing money, of going in circles before you can actually make money. I know, because I took 8 years, right? So if you can take 5 years, you're already better than me. So the reason people take this course is because they say, Adam, I want to cut short my learning curve. I don't want to spend the next 5 years learning, going in circles and wasting time. I don't have much time left, right? I want to learn everything the right way now. So in 5 years, I'm already halfway to my financial goals. In 5 years, I already hit that first $1 or $2 million. So again, if you feel that you don't have much time left and you want to accelerate your financial results, this course will give you that, the tools and the skills, right? So let me run through the 12 lessons which are in the class. And again, they are on-demand courses. You can watch it anytime, anywhere, lifetime access. So lesson number 1, we start with the stock market basics. In this course, I assume you know nothing. We start from the very basics. What's a stock? Why does the price go up and down every day? What drives the price action? What are the different stock exchanges in the world? What is the stock index? What are the different approaches to making money? Whether is it capital gain or collecting dividends, right? We cover all the basics. You know, what's a PE ratio? What is earnings? What is price? Everything. Then lesson 2, you will learn all about how to invest in ETF, exchange traded funds. Now, there are hundreds and hundreds of ETFs. You've got China ETFs, you got India ETFs, you got US ETFs. So how do you choose the best ETFs? Right? In the course, I've got a certain criteria to select the best ETFs to invest in the different markets. Now, besides stock ETFs, we also have got commodity ETFs, bond ETFs. Right now, the interest rates are coming back down. I think bonds will have huge potential to rebound. So recently, I bought a lot of the bond ETF, TLT, and I'm already making a lot of profit on that one, which I shared with my students, right? So you learn about bond ETFs, commodity ETFs. You also have got inverse ETFs, which make money when the market goes down temporarily, right? So you learn about how to use ETFs. And again, what are the best entry and exit strategies to invest in ETFs? Once you learn about ETF investing, then you learn how to pick stocks of great companies. But to do that, you have to learn about fundamental analysis. So in this course, you learn exactly how to analyze any business inside out to know, is it a great company or is it a lousy business? You learn how to read financial statements and financial ratios. You don't have to have any background in accounting. I assume that you have got zero background. You learn it in a very simple way, okay? And In the course, you're also going to learn, how do you know when a company is legally manipulating their accounts creatively, where on the surface it looks very good, but actually they're not doing well. I've got so many students who say, Adam, I wish I learned this 10 years ago. I would never have invested in High Flux or Nobel Group or NOL, right? Because once you learn this, never again, listen, never again will you buy a lousy company. You will only buy the best 1% in the world, okay? And you learn how to screen for the best companies in every market. Lesson number 5, all about stock valuation. You will learn how to calculate the intrinsic value of different companies, whether is it a REIT or it's a bank or it's a technology company. How do you calculate the intrinsic value? For example, a lot of fellow Singaporeans want to buy the Singapore banks. I think the 3 Singapore banks are great. DBS, UOB, OCBC, I own all 3 for dividends. Right now, DBS is a bit overpriced, but UOB, OCBC is still undervalued. So you're going to learn how to calculate your own valuation. So you know, you don't have to wait for me to tell you. You know when it's cheap and expensive, right? Then lesson 6 about technical analysis on how to optimize timing your entry and exit based on reading the chart patterns. You learn things like, how do you identify market trends and cycles, uptrends and downtrends, wave patterns, support resistance levels, moving averages, and a whole lot more, okay? Lesson 7 is where you learn my proprietary 7-step VMI formula. So this is where you learn my entire 7 steps so that you only buy a stock if it passes the 7 steps, right? So there'll be a lot of case studies, a lot of examples so that you acquire these skills. Lesson 8, you'll learn how to build a winning portfolio that is bulletproof, that's resilient, that can do well in any economic condition. So to me, I don't care if there's a recession next year. I don't care. Because I know recession or no recession, high inflation or low inflation, when I've got the best companies in the right combination, they will keep growing over time. I'll keep doubling my money every 3 to 5 years. Okay? Lesson 9, you will learn how to find investment opportunities using software screeners. And someone asked a question, yes, I use a lot of AI nowadays to research on stocks, and it makes it a lot faster. And how do I find companies very fast in different markets that are great and undervalued? You also learn how to manage your portfolio and when to exit an investment. Okay. Lesson 10 is one of the most important lessons, which is the psychology of investing. I can tell you that psychology plays a very big part in investing. So I will go in depth on how to rewire your mind to think differently from everyone else and to be a very successful investor. Example, as a successful investor, we never invest based on predicting short-term price movement because no one can predict for sure. We never invest based on reading or watching the news. Waste of time. We never buy and sell based on emotions. We buy and sell based on what? Numbers, on facts, on technical chart patterns. Lesson 11, all about stockbrokers. How do you choose the right stockbroker to meet your objectives? And what are the most reputable, safest stockbrokers to use with the lowest commissions? How do you place orders? How do you click buy? How do you click sell? And how do you open an account with the broker? Lesson 12, how do you turbocharge your portfolio? When most fund managers only get 12% or 15%, how do you get 20, 30, 40, 50% returns in certain years? Like my students, by using options to turbocharge your portfolio. That's right. So in this course, you will learn some of the basics of how to use options to turbocharge your investments. And of course, for advanced options, we have got our separate options trading course that I highly suggest that you can enroll for as well. It's like 60, 70% discount right now during the black market event. So go grab it, okay? All right, so for this special black market event, we have got limited time bonuses. Number one, you'll be getting all my trademark investing tools once you enroll right now, which includes the intrinsic value calculator, the portfolio manager, or we call it portfolio tracker. It's on an Excel sheet to track all your investments, your buys and sells, and a portfolio dashboard to help you to see how your portfolio is doing every day. Okay, this is worth $300 US, and you'll be given as part of the package for you right now. Bonus number two, you will get a free lifetime access to our investors chat group. We are in the Discord channel as our private community, and we chat every day, 7 days a week, 18 hours a day. I'll be in the chat group together with you, together with all our students. So anytime you got a question, you post a question, we're there to help you to answer. If you have a great idea for stock, share your idea. Hey, I'm looking at this stock. What do you guys think? We are there to give you our feedback. And other members will also share their ideas. Many of my students tell me, Adam, in the past, I could never succeed as an investor because to do it alone is very difficult. You know, after a while, I lose interest, I lose motivation, and I don't have the discipline to follow the rules, right? But with the community, everyone is so encouraging. Every day they remind me, follow the rules, ignore the noise, ignore the bad news in the market, focus on the company. And every day they are so encouraging, and everyone shares their ideas. That's how I'm able to succeed, right? So when you've got a community behind you, 7 days a week, 18 hours a day to share ideas with you, to encourage you, to remind you to be disciplined, it's impossible to fail. So one of the reasons why my students are so successful is this community that we have created. These were what my students have shared in the community. This is Ronnie. He said, had I not belonged to this group, I could have been screwed big time. I just wish I had enrolled in the course earlier. At least now I'm closer to my goal. And this is John. We have blocked up their surname in case some of you go and disturb them, right? He said, Adam, I want to personally say thank you. I'm very new to investing and the stock markets. And at first, I tried to learn on my own. I lost a bit of money, and the best decision I made was to sign up for the Value Momentum Investor course. In 3 months, I've more than tripled my course fee in the markets. This is VJ. He said, seriously, I did not expect the kind of support from Adam on the Telegram, which we used to use last time. He answers everyone, and it's a great online course, but the support we get in the community is matchless. I keep asking my friends to join the course as well. This is Sunny. He said, Adam, I can't say enough. You're the best teacher in the whole wide world. I've been to many paid courses, but no one out there would take time after hours, whether it's on a weekend or weekday, to answer questions and steer us in the right directions. Every dollar spent on your courses is worth millions. Thank you very much. And although I've been teaching for 18 years, every time I read this, it still touches me. It still makes me feel so appreciated. You know, I still have people who ask me, Adam, why do you bother to teach? You've got over $12 million. My dividends alone from my dividend stocks is $250,000 a year. Pays for all my expenses. Every year, my capital gain is at least $1 to $2 million every year. I don't have to work for the rest of my life if I don't want to. So people say, Adam, then why do you work? Why do you do webinars? Why do you do YouTube? Why? I tell you why. Once you have made your money, once money is no longer an issue in your life, you find you have no more purpose. And you get bored. You get depressed, actually. And you need something to make you feel that you have a purpose. And every time I read these appreciations from my students, it is worth more to me than making another million. I can tell you that. So I thank you, my students who have been with me on this journey for the last 18 years and sharing your appreciation, because it is what gives my life meaning right now. And That's why I continue to do this. And I can tell you that even today, if I had $10 billion, I will still teach. I'll still do YouTube videos every week. Because with more money, it doesn't make you happier, right? But money just gives you the security and the freedom to do what you love. And for me, I love teaching. I love being with my community. And whatever it is for you in your life, go for it. Go for financial freedom, go for financial security, and do what you love, because our life is not that long, right? And if you have to work, struggle in the rat race just to earn money, there's not much meaning in life. That's why the purpose of wealth is not to show off to people the new car you buy or the new clothes you wear. I wear simple clothes. I don't even own a car in Singapore, by the way. I take public transport. Because to me, I find that money, the most important thing, gives you freedom and gives you security, you know, and that is the most important thing. All right. So this entire package consists of the value momentum investment course, 12 lessons, 26 hours, is valued at $1899. That's the retail price, US dollars 1899. Plus, you will get the two bonuses I mentioned. So the total value is $3399 US dollars. For today, when you enroll in the black market event, the course fee is $1899, right? $1899 one-time enrollment fee for a lifetime access to the courses and a lifetime access to our private community. But wait, there's more, okay? We're also going to throw in the Ultimate Investors Playbook. Now, this is called the UIP. Now, the UIP is not a course. This is not a course. This is a mentorship subscription where you can watch me invest and trade every day. It's like being my apprentice. You're kind of like looking over my shoulder and seeing what I do every single day. So the UIP is not a course, it's a subscription. Now, let me give you a metaphor. The investor course is like a cooking school where I teach you how to cook and I give you all my recipes and you cook yourself. Yeah. The UIP is where you come to my restaurant and I cook for you. And I put up the buffet spread and all you got to do is to take the food from the buffet, right? That's the best metaphor, right? So the UIP is an annual subscription, but we're going to give you a fantastic deal to get the UIP for the first year. Yeah. Now in UIP, what you get monthly stock market deep dive analysis, where I will give you my unbiased fact-based research on exactly what's happening in the markets, in the economy, and to show you the latest opportunities in the different sectors and markets. Every month, I will do a review of my portfolio where you can see all the stocks in my portfolio, as well as the intrinsic value, the buy levels where I will add more shares, as well as my portfolio allocation. This is done every month where I review my portfolio, every single detail to you every single month. All right. I'll also do a monthly watch list review where I will review all the stocks I'm watching that I have not bought yet, that I may buy very soon. Again, I will do all the intrinsic value calculations every month, updated together with all the buy levels where I will add shares. You will also get live buy and sell notifications. So once I buy something, sell something, in 3 minutes, you will get a screenshot of my buy and sell notification. You can see exactly what I'm buying and selling, including all my option trading is also live alerts. Okay. And every month I will do a deep dive research onto 2 stocks where I'll go through the 7 steps. So you find a lot of new great companies every month that you could invest in yourself. And you also get exclusive access to my UIP Discord chat group, which is a separate chat group from the investor course. So you'll be in 2 chat groups. Okay. So this is an example of my monthly portfolio review where I will review the markets, looking at the technical chart patterns, as well as all the macroeconomic data, fact-based, unbiased research. I'll do a full portfolio analysis where you can see my every single position, my average price, my profit, my loss, my allocation. And we do a deep dive research into 2 companies every month, right? And you get my live buy and sell alerts. I remember that in 2020, during the COVID crash, the market bottomed on 24th of March. Straight away, I bought my first stock, 25th March, on the second day from the bottom, which was MasterCard. I bought at 236. This alert went out to my students in 5 minutes. And on the 30th of March, over here, I added Facebook at that time, which is now called Meta, at 159. So you know exactly what I'm buying and selling every single day, including, again, my options trades as well. Okay. These are some recent ones that I've shared in my community. 19 May this year, you can see I posted on the notifications. I sold McDonald's at a net sales price of $291, and that's a 65% return on my capital. And a few days ago, on the 7th of October, sorry, a few weeks ago actually, I bought back McDonald's. Oops, sorry, give me a second. Let me get rid of this. Yep. I bought back McDonald's at 249, right? And again, this is a screenshot. You can see why. Can you see McDonald's here? Wave up, wave down, wave up, wave down, hit the blue line, buy. This was an alert I sent on LVMH. I said my buy price is 143, and I was waiting for it to drop here. And then the alert was sent. I bought at 141, right? So you get these alerts almost every day. This is one of my UIP subscribers. He said, "Hello, friends. I also want to share my results. I could nearly double the performance of the S&P 500, 28%, right? And I got 50,000 US profit, which I earn in euro. It's from Europe. I also achieved my goal for the first time to make more money in investing than with my working job. Thank you so much, Adam and the team." He said, without it, I wouldn't have been able to do it. This is Eric. Thank you, Adam and the UIP members. Thanks to Adam's advice, more importantly, psychological training, my personal portfolio has grown 40% year to date. All right, this is this gentleman here. You know, again, it goes on and on, but these are all my subscribers, right? Again, this is Anthony. This is Daryl, up 85% this year. My UIP stock portfolio is up 85% this year, right? And it goes on and on, right? This is Adeline. Earn back my course fees, right, by November. Okay, so the UIP subscription, the total value is $6,007 a year value, okay? Now, the usual subscription fee is $1,900 US. For today's special, you'll be getting both the whale investor course plus the UIP. Now, remember, they are both about $2,000 each. So total is $3,799. Now, for the limited offer right now, if you scan this QR code or click on this link, you will get both the investor cost and the UIP for only $1,329.65 US. That is a crazy discount. That only happens once a year during this black market event. So that's a 65% off. So guys, this is like a great company selling at 65% discount, right? You got to grab it because this is going to be worth more than any other stock investment you ever made. All right. So click on the link, do a screenshot, and you can enroll right now. Yeah. Now, as a bonus, I'm also going to give you, when you enroll now, a lifetime subscription to my monthly newsletter. Okay, so this is for people who only enroll now. And number two, when you enroll now, you also get an additional 2-month subscription to UIP. So there's a total of 14 months. And most people, after 14 months of following me every day, they say, Adam, I don't need you anymore. I know exactly what you do. I can do it myself, which is fine. You know, I'm not the kind of person who I want you to subscribe to me for the rest of your life. No. Once you've learned enough, you can do it yourself. But I'll still be there to answer your questions if you want to. But if you want to hang around and be with me, I'm happy to have you as well. All right. Now, fast action bonus for those of you who are the first to enroll right now. You'll also get an additional 3-hour online session with our resident trading coach, this guy called YY. By the way, he's got 2 portfolios. He's up 90% in one portfolio where he trades options, and his investment portfolio, he's up about 50%. So this is one of the best investors and traders in our community, and he'll be doing an additional 3-hour online live session as part of this extra package, right? So once again, QR code, click on the link, you get both the whale investor course and the UIP together, usual combined 3,799, today 65% off for 1,329.65. It's a steal. Grab it, okay? By the way, if you go to our Piranha Profits website, you can see that all our courses, our options course, our price action manipulation course, our trading course, and the different mentorship playbooks, they are all up to 75% off for this very limited period. Yeah, so grab it while it lasts. Yeah. Okay, so while you guys are enrolling right now, I can see a lot of questions that have come into the Q&A chat. I'll do my best to answer as many questions as I can. And at the same time, remember to enroll now so that I can see you guys in the community as soon as possible so we can take advantage of the bull market. Yeah. All right, so let me look at the questions that have come in and do my best to answer them. Okay, question on Alibaba. So you guys know that recently Alibaba announced their results. Their revenue grew at 9%. Their free cash flow grew at 27%. So if you ask me, is the business doing well? Yeah, business is growing. Business is doing well. And they've actually been taking market share from, I think, Shopee and all those things, right? But the bloody share price dropped 9%. You may say, why? Company doing well, where share price drop? In the short term, it can happen. One reason is because SoftBank, which is a Japanese company that owns about 20% of the Alibaba shares, they are in trouble. They're not doing well. So a lot of these companies are forced to sell the Alibaba shares to get the cash to survive. So all this creates the short-term downward pressure on stocks like Alibaba. So I'm still holding Alibaba, but it's a very small position. I've got less than 1% in my portfolio. Now, would I add more shares? No. Okay, I'm just holding my position. I'm not adding more. Neither am I selling, right? Because once the big companies, they're selling, Alibaba stop selling, and sentiment improves. And the good thing is now Xi Jinping is trying to make friends with the US again. I think once all that is sorted out, I think China's stocks can then go back to their true intrinsic value, which will be double or triple. But it will take time. If you ask me exactly when it will take, I can't predict, right? So to me, it's a whole. I'm not adding more. Neither am I selling, all right? Okay. Is Yum China and Salesforce fundamentals great? Yes, I think so. To answer that question from Sam. Someone is asking me to talk about waste management, WMC. Waste management is a great company. but I've not been really tracking it closely, so I can't really comment on some short-term developments, right? NYMT, I'm not familiar with that. Another question on the Chinese market, which I just answered actually. What do I think about the US national debt and all that? I don't bother about it, or I don't really give a shit about it, right? You know why? Because ultimately, I'm not buying the US government bonds and all that. I'm buying companies. And as long as I buy companies like Google that have no debt, I don't care what happens to the government. Government can go bankrupt for all I care. I own the companies that have no debt, that will continue to do very well, that everyone is using these great companies, right? Can I explain about commodities? Commodities are something I do not touch. I do not touch commodities at all. And the reason is because commodities are very, very unpredictable. And I only like to buy things that are very predictable. You know, oil price can go up and down, gold can go up and down. So commodities and companies that deal with commodities, if you look at their earnings and their stock price, is very erratic. And it's something that I don't like to touch because, again, I like things that are very predictable and consistent so I can sleep well at night, you know. Okay. What do I think about robo-advisors? Well, it depends, right? So you've got good robo-advisors, you've got lousy robo-advisors. But if you ask me personally, would I put money into robo-advisors? I won't. Why? Because I know that when I invest myself, I can get much better returns myself without paying them any fees. So to me, I would invest in robo-advisors, right? Why did I sell NVIDIA? All right. Yeah, I recently sold all my NVIDIA shares. The reason I sold it was because I actually sold covered calls on NVIDIA, and my covered calls got assigned. And so I sold my NVIDIA at about 150% return. And yeah, I'm going to buy it back, right? I'm waiting for it to dip lower and I'm going to buy it back soon. But I'm waiting for it to get below the intrinsic value. And right now, NVIDIA is still slightly overvalued, right? Why do I have two accounts on Interactive Brokers, right? Actually, my two accounts on Interactive Brokers are actually almost the same. They're almost exact. The only reason I've got two accounts is because one is a personal account and one is a more of a corporate account, right? So, and it's something which in the future, if I want to give one account to my kids, for example, I could just do it, and the other one I just hold it, right? So it's more for that reason. But I invest in both of them exactly the same way. What is my view on Boston Beer? Boston Beer is beginning to recover. The recent quarters, their revenue and profits are beginning to accelerate. So, yeah, that's why I think it's worth holding, in my opinion, right? Would I consider Broadcom? Broadcom is okay. It's not a bad company, all right, but I think there are a lot of other companies that are even better than Broadcom, right? Would I consider buying back TSM? Not really. Now, the reason I sold TSM, Taiwan Semiconductor, is not only because of the Taiwan issue, but generally I don't like companies that have a lot of physical capital expenditure, CapEx, right? Because they have to spend a lot on CapEx on physical assets. And I prefer companies with low physical assets. So they have got a lot more free cash flow. Question on how AI will affect investing in the future? Well, like I said, the good thing is AI has actually helped me to do research a lot faster. But I can tell you that with all the AI, people will still underperform the market. And most fund managers will still not be able to outperform the market because, like I said, the reason why a lot of people cannot do well in the markets is not because of lack of information, it's not because of lack of intelligence, it's because of their emotions. It's because they are affected by the emotions of the market, the fear and the greed. That's the reason. And that will never change in human history because humans are wired psychologically to lose money. So the biggest secret to investing is not just the quantitative part, which can be expedited through AI, but it's the qualitative part, which is the psychology part, which is the emotional part that most people don't have. That's why in my courses, I emphasize, and in the community, I emphasize just as much on the psychology than the quantitative. And that is what makes a difference. At what circumstances will I buy Boeing back? No, I won't buy it back, right? Because I think that Boeing is still a good company, but there are still a lot of execution risks, which I rather buy a company with less execution risk. So remember, a company can be good, but I still sell it because I find another company that's even better with less execution risk and less uncertainty, right? So no, I don't intend to buy back Boeing. All right, so a lot of questions on China, which I think I answered that first one already. Why do I consider Palantir and LVMH great businesses? I can't go into that in detail. Again, like I said, when you take this course and you put it through the 7 steps, which I'm going to teach you in the course, you'll know why they are great companies, right? And in the UIP, I will do all the research. You can read my deep dive research reports to know why I think they are great companies. I can't answer in one sentence because it's like a 30-page report on any company I buy. Yeah. So the important thing to remember is that when you subscribe to my UIP subscription, my job is not to just tell you buy this and sell that. No. My job is to tell you what I'm buying and what I'm selling and to show you all the research I do so that when you buy and sell, it's not following me blindly, but it's based on my research and my own personal investments so that you learn how to do it yourself in the future. Okay. All right, let me just take a last few questions and then I will hand the session back to my team. By the way, coming up next will be the webinar on price action manipulation by Elson Chu. It's something that you have to learn. I have learned so much from Elson myself over the years. He has actually helped me to be a much better trader as well. And I learned about how the markets are manipulated a lot by him because he spent a lot of time as a professional prop trader, making a couple of $1 million in the markets by exploiting how market makers manipulate the market. So in his coming webinar, he'll be talking about how he trades stocks that gap down. You know, sometimes stocks like Alibaba, they gap down and people get scared. That's how he makes a lot of money, by learning exactly when to get in after gap down in order to make money on a huge rebound. So stay for his next webinar on price action manipulation. It's really worth learning. It's really worth taking his class as well. All right. So with that, I thank you for listening to me. Let me just take last 3 questions. And for those questions that I couldn't take, we will you send us an email and we'll answer your questions on email as well. Okay. So let me just take a last few questions. What investments do you advise a 25-year-old to invest right now? So it doesn't matter if you're 25 or 55 or 45. It's the same thing. Only buy the top 1% of companies that meet all these investment criteria. Will the US presidential elections affect the stock market? Yes, in a positive way, right? So this year is the pre-election year. Next year is the election year. Markets tend to be bullish during pre-election and election years. Okay, I think those are all the main questions I have answered. Okay, last one. Do you think it's a time to invest in Singapore banks? I did talk about it recently. I think DBS is still a bit expensive, but UOB and OCBC, in my opinion, are still undervalued. All right, guys. So thank you for listening. I hope you've learned a lot. And I'll see you tomorrow for my next live webinar on how I trade options together with Bang Fang Van's options webinar as well. So I'll see you guys tomorrow. But remember to stay for Elson's coming webinar. Take care, guys, and I'll see you soon.